The need for deepening corporate markets and widening investor base has become even more crucial now to revive the economy for an unprecedented slowdown caused by the pandemic. There are certain barriers that come in the growth process of the debt market. To understand what great minds are thinking about the issues and challenges of the debt market in India, on behalf of Bombay Chamber of Commerce and Industry, I, Priya Singh, would like to extend a warm welcome to one and all on today's panel discussion on corporate debt market in India, issues and challenges. May I now request Mr. Nilesh Shah, President BCCI, to please deliver the welcome address.
Distinguished keynote speaker Shri Rabi, Deputy Governor, Reserve Bank of India, Moderator Latha, Executive Editor, CNBC, Tamalda, Consulting Editor, Business Standard, fellow panelist Neeraj Gambhir from Axis Bank, Jayesh Bhai from Bank of America, Rajiv Bhai from Axis Bank, Abizar from Ernst& Young, Suresh Krishnamurthy from CRISIL, and Professor Anand from SPJIMR, past presidents, members of Bombay Chambers Board, distinguished guests, ladies and gentlemen. On behalf of Bombay Chamber, I would like to express my heartiest welcome to each one of you for today's topic, corporate debt market in India, issues and challenges. At the outset, on behalf of Chamber and my own behalf, I would like to express my sincere thanks to our speakers for kindly accepting our invitation to address the members. Our special thanks to Sandeep Khoshla, DG Bombay Chamber, for his relentless effort in materializing today's discussion, and all of you who have joined us today. Let me take a few moments to talk about Bombay Chamber. I have the proud privilege to mention that the Chamber, established in 1836, has a long and illustrious history of continuous service to trade and industry. As Bombay Chamber, we worked with the government to establish first railway line in India between Mumbai and Thane. We were instrumental in bringing Bombay Port, as it was known then, and many other initiatives so that trade, industry, and commerce continues to flourish in the city of Mumbai. The Chamber acts as a bridge between civil society, government, and its member organization, and aims to promote the interest of all the stakeholders in the overall interest of the country. Debt market, we have two contradicting factors over there. On one side, our infrastructure is at par with the best in the world. Electronic trading, electronic settlement, guaranteed settlement, whatever one needs from physical infrastructure point of view, we are right there with the best in the world. When it comes to trading, there are pockets which are extremely liquid, and there are pockets which are not so liquid. Over the years, many steps have been taken to develop bond market. Some have worked, some haven't worked. And clearly, today, when India is looking to grow from about $3.5 trillion GDP to higher level, it will require efficient and vibrant debt market to provide capital for funding that kind of growth. Over the years, lots of steps have been taken. There are still some steps which are needed to be taken. And I hope and pray that today's seminar can bring market minds and regulators together to find out what steps are needed to make our debt market as vibrant as our physical infrastructure in the debt market. With this, I will invite Deputy Governor to kindly come onto the stage.
Thank you, Mr. Shah. Sri Shankar doesn't need any introduction. but this is my privilege to have an opportunity to say few words for our honorable keynote speaker. Shri T. Rabi Shankar, a career central banker, joined the bank in 1990 and has worked in various positions in the Reserve Bank of India. His current areas of responsibility includes reserve management, public debt management, payment systems, IT infrastructure, currency management, and foreign exchange management. Sri Shankar has served as an IMF consultant from 2005 to 2011 on developing government bond markets and debt management. He has represented RBI on international forums like Bank for International Settlements and various internal and external expert committees and working groups. Sri Shankar has Master of Philosophy in Economics from the JNU, New Delhi. Ladies and gentlemen, please welcome our keynote speaker, Shri T. Rabi Shankar.
Mr. Nilesh Shah, President, Bombay Chamber of Commerce, other senior officials of Bombay Chamber of Commerce, uh, and everyone that matters in bond markets that I can see in front of me. Jayesh, Nilesh, Anand, and others as well. Plus, I'm seeing Latha, so many others. The combined wisdom of the people sitting here is probably all the wisdom that exists in our bond markets. So I have had a look at these sessions, and I think you couldn't have put together a better team or a more comprehensive team to understand the issues that are there. My job is relatively easier. What I propose to do, taking advantage of the fact that, I start off the proceedings, so what I plan to do is lay the ground for the discussions that will follow on this. Briefly, what I propose to do is highlight why bond markets, corporate bond markets are important. What have been the regulatory efforts so far? What is the report card today in terms of resource mobilization through this market, in terms of the liquidity metrics that exist in this market, which is probably the crux of the issue, in terms of the development of complementary markets. And then I will round it off with some of the issues that arise and some of the issues that we need to address. I do not intend to, nor do I have the answers. I do not intend to provide those answers to these problems. There are so many high-level groups which have had a look at it. It is difficult to say anything else that would be new. What is probably required is what approach we need to take, what are the items that we need to prioritize. I mean, just as an aside, I remember about 8, 9 years back, many people in the market said corporate bond markets, there wouldn't be, secondary market would just take off. You introduce corporate bond repos. We introduced corporate bond reports, didn't work. So it's not really a question of what would and what wouldn't. We have to prioritize. We have to introduce. We have to lay the groundwork, create the ecosystem, and hope that at some point of time it takes off. Towards the end, I will also talk a little bit about what we need to do with our expectations, because very often we tend to look at the corporate bond market from the viewpoint of our past. If I'm from the government bond market, I tend to look at the corporate bond market, but using the understanding I have in government bond market. So for example, I will say consolidate, secondary market liquidity will increase. Similarly, if I'm from the equity market, I see a lot of liquidity in the equity market. I will come from the equity side and suggest things. The point is we have, I think, to realize that this is a market with its own character. This is a market with its own drivers. We can take the experience we have, but we cannot really replicate those things here. Now, with that brief introduction, I will just start off with my address. An active corporate bond market serves multiple functions. Apart from providing borrowers an alternative to bank finance, it can lower the cost of long-term funding for borrowers for the economy. Banks, ours is a bank-dominated financial system. Banks are typically constrained in lending long-term simply because of the fact that liabilities are short-term. An efficient corporate bond market in this sort of a scenario with lower costs and quicker and more flexible issuing times can provide an efficient and cost-effective alternative to bank finance for corporates. At the same time, it can provide institutions like provident funds, long-term institutions like insurance company, long-term assets which are very difficult to come by in the economy, the so-called preferred habitat, helping them to match their durations with their liabilities, which are long-term. So the gap between banks which have short-term liabilities and let's say insurance and such funds which have long-term liabilities can be effectively filled by the corporate bond market. From a macro financial or financial stability perspective, a well-developed corporate bond market serves to spread risk away from the banking system. Banks are key to financial stability. All of us know that, as they provide basic services to any economy, liquidity services, provide credit, provide payment systems. Now, given that these are all extremely important macro services that banks provide, it is important to regulate their risk-taking abilities. A market-based source of finance in this sort of a situation, such as a corporate bond market, is more effective in dissipating risk across a much wider range of investors, thereby contributing to overall financial stability. A good corporate bond market can contain financial stability risks by diversifying risk away from the banking system across others who are willing to take that. In other words, what long back Greenspan said, it can perform as a spare tire in the economy, mitigating financial shocks and preserving financial stability. It is because of these benefits that corporate bond market provides that government, SEBI, RBI have been making concerted efforts over the last 2 decades. I can remember the very first small report written in the Reserve Bank sometime in 2002 or 3, around that time, followed up with a lot of more detailed reports by by participants both within India and outside. So the process had started long time back. That was the time we were also trying to develop the government bond markets, which is one reason why there's a lot of similar thinking across these two markets. I would very briefly dwell upon what are the basic regulatory initiatives that have been taken in the corporate bond markets by the major regulators. SEBI is the primary regulator for corporate bond market. It has taken extremely significant steps, primary of them being delivery versus payment, which reduces settlement risk, introduction of a trade reporting platform. I remember we started off with FIMDA having that trade reporting platform, and then it was rationalized and put in place through exchanges. You have these electronic bidding platforms, and more recently the platforms using request for quote for secondary markets. The SEBI has issued some regulations for consolidation of stock issuance and so many other steps that they have taken. RBI, which it's not its direct responsibility, but still has taken certain measures. One of them is obviously the partial credit enhancement measures that it has taken. Another that it has taken is to sort of nudge large borrowers to gradually increase the share of their funding that they would access through bond markets. It has, it has taken some steps through for better FPI invest in corporate bond markets, increasing limits over time, introducing the VRR scheme, and so on. Generally, all entity regulators, like whether RBI, IRDA, or PF, RDA, they have all encouraged their regulated entities to invest in corporate debt securities. So there has been an all-round effort. Government has helped in terms of putting in place the necessary legal and regulatory framework. Everyone has taken these steps over the years in a concerted manner, picking off from various groups that have been set up for this purpose. So where do we stand today? All these measures, let's go bit by bit. First, resource mobilization. How has the market done in terms of resource mobilization? In this context, I'm reminded of someone in this audience who once told me, and this was 15 years back, that who says corporate bond markets are not liquid? If a corporate tells me that I want to mobilize 3,000 crores, I can mobilize it in 2 days. I mean, at the end of the day, a market exists to provide funding to people who want to borrow. Now, if I can do that in 2 days without affecting the market, why do you say that the market is illiquid? Just because there is no secondary trading? Good point. But it's a good point, but it's a point, that has largely, in my opinion, largely been missed. We tend to focus too much on what would be required in the secondary bond market. And we, to that extent, downplay the achievements that the regulators and the markets have achieved in the primary market. In terms of issuance size, over the last 10 years, roughly from 2012 to, I just took 10 years, end of 12 to end of 2022, the outstanding has gone up by about 4 times, over 10.5 trillion rupees to roughly about 40 trillion rupees, which is fairly close. Annual issuances have gone up from a little below 4 trillion a year to about 6 trillion a year. So the market has been growing in terms of mobilization of resources. In terms of flow of a good indicator is in terms of flow of resources to the commercial sector. If anyone can't see the slides or something, it's there in the speech. We'll put up the speech at the end of today on the RBI website. One good indicator is the ratio of gross private placements by non-financial entities to non-food credit. And this indicator, although there are year-to-year variation, we should not take any particular year's numbers too seriously, but the number has clearly increased from about 9% in 2010-11 to about 40 to 50% in recent years. So in terms of primary mobilization, we have done reasonably well. Probably one of the factors that is given is scale to GDP. For example, we generally look at the ratio of corporate bond market to size of GDP and say that we are fairly low at 18%. We probably need to increase that over time. Although the primary issuances seem to indicate that we are moving towards that, it falls well short of, let's say, China, which is around 36%. Korea, which would probably be just above 80%, and US, which, if I remember right, is above 100, maybe about 120% or thereabouts. So we probably need to go towards that, but we have to keep in mind that it is not necessary for us to move away from a bank finance dominated system for corporate bond markets to develop. We can have developed corporate bond markets, and we can have banks playing a big role as well. So it is not necessary that we end up where US is today. It is enough if the corporate bond market in terms of mobilization, in terms of size, increases over time. Now, along with this increase in issuances, etc., the diversity of issuers has also improved, especially of late. We have got funds like REITs and InvITs, especially after the after the legal amendments that have been brought forward. They have also started issuing instruments in this place, in the bond market. One important aspect, one important source of bond issuances, let's say in the US, is municipal bond markets, where regulations have been issued for this market to evolve, develop. But I think we still need to go a little bit further in terms of getting, getting the municipal budget transparency, accounting transparency, etc., in place before that market takes off. One point that we have to keep in mind while on the subject of municipal bonds is that, again, when we look at US municipal bonds and say we should have a muni market, which is somewhere there, we have to keep in mind that the federal structure of devolution of funds in India is very different from that in the US. In India, funds devolve from central government to state government. Both have their own resources as well. And it is state governments which actually do a large part of the infrastructural spending at the state level. State governments issue bonds in India. Go to US, state governments rarely issue any bonds. Most of the large spending there is decentralized. It is done by the municipalities or corporations that run those cities. So you have a municipal bond market. In fact, if you look at that, you should compare a municipal bond market with the state government bond market here. To expect that we will have both a state government bond market and a municipal bond market, a little bit unrealistic. Does not mean that we cannot have a municipal bond market. We can have. There are large municipalities which take up, Bombay, for example, which take up large projects, and they can have a sufficiently sized bond market, which can, which can help liquidity in the overall corporate bond market ecosystem. There are a few other factors which testify to the development of the corporate bond market. One aspect is pricing. You look at, everywhere corporate bond markets are priced off the government securities market. You look at the relationship between corporate bonds and government bonds over the last 15 years, 20 years. I'm saying look at it long term. You would see that there is a fairly close alignment. Spreads go up when there are volatile times, spread narrow down when conditions are conducive for bond issuances. But the fact remains that in terms of pricing, corporate bond markets are fairly liquid. If you look at, the way they move in terms of spread to the government securities market. Another aspect of this market is its ability to innovate and adapt. And one of the things you see is comes up with new instruments. Of late, they're coming up with floating rate instruments. Good time to have those. During the pandemic, you saw instruments which were sort of conditional credit risk premium instruments. Many such instruments are coming up. So the ability to innovate does exist in these markets. One factor that probably constrains this ability is I'll come to that a little later, is the existence of supporting markets, like derivative markets. I'll come to that a little later. In terms of liquidity metrics, secondary market, look at the volume. The volume over the last 10 years, again, 2010-11 to 2021-22, has gone up from about 4.5 trillion rupees to about 14 trillion rupees. Now, this is nowhere near the 10-time increase that we have seen in the primary issuance. But then we have to keep in mind that the secondary market volumes are, in fact, going up over time. Not where we would have wanted them to be, but they are there. The point is, yes, secondary market trading volumes are low, but we'll again have to pause and look at it a little, bit more critically. I was part of a group about 3-4 years, set up in BIS, establishing viable capital markets. So we, in the group, we picked up some advanced economies, picked up some emerging economies, and looked at liquidity aspects. And the general conclusion of that report was that of the surveyed, the liquidity concerns in the corporate bond markets in the surveyed economies, other than US, which stands at one end, at between developed markets and emerging markets, the concerns are on average similar. So what this tells us is that the lack of secondary market liquidity is a global phenomenon. It's not something that only we are dealing with. Now, one way of looking at that is, yes, probably that is the very character of these markets. And what we expect maybe a little bit, we're unrealistic. The other way of looking that is, this is a problem that is difficult to deal with, as the rest of the world is also finding out, including developed economies other than the US. One factor that I remember at that point in time, we were looking at turnover ratio. I was frankly surprised. Our turnover ratio was about 69%. Turnover ratio would be total volume over outstanding secondary market trading volume over outstanding stock over a year. 69% isn't anything great. But surprisingly, this number was second only to that of the US. So, you look at these things, it seems that, we have to, before we draw a conclusion that my secondary markets are illiquid, we probably have to rephrase that approach, relook that approach. Not to say that we should not start, our markets are developed, we need not do anything. There's a lot that can be done. We will come to some of those issues. But, focusing too much on secondary market liquidity hasn't really helped us and is unlikely to be that much of help in the future. We need to focus on what is more important. Why does the secondary market liquidity not happen? One factor it doesn't happen is the small size of issuances. In the corporate bond market, for example, as on 30th June of this year, outstanding instrument was roughly about outstanding instruments were roughly about 30,000, and the outstanding stock was about 40 lakh crores. This works out to an average issue size of about 130 crores. Now that is not something that is very, of course, looking at averages is not necessarily the right thing to do. But on a larger scale, this gives you a picture. Look at the government securities market instead. I'm not saying they should be compared or government securities, corporate bonds should get to that level. But just to make this point, you only have 100 securities, you have about 85 trillion rupees. Now that's 85,000 crores, an instrument. So that doesn't mean every instrument trades, even there 4 or 5 or 10 instruments trade. But then the fact remains that fragmented issuance is one of the issues that we have to deal with. The other is basically the very large number of issuers. Government is the only issuer in the government bond market. Government has the highest credit risk, so credit issue completely disappears. Look at corporate bond market. It has about, I think this year it had about roughly 5,400 issuers. So many issuers, so many bonds, so many of them small size. It is extremely difficult to get secondary market liquidity in that. There have been efforts, SEBI's efforts at consolidation, for example, to reduce fragmentation and improve liquidity by limiting the number of ISINs, limiting the number of bonds that you can issue in a year. The constraint here is that a corporate does not have the tools available to a government to meet the rollover risk implicit in bunched up repayment obligations. Government can easily do that because it has, it has a lot of instruments. It has, and in the end, an ability to tap the system liquidity. Not all corporates have that, and even the best of them do not have that ability as, nearly as much as a government has. There are several other reasons. One major reason is our holding is largely institutional, and most of those institutions, in terms of their respective organizational structure and mandate, are not really, cut out for secondary market trading. Many of our instruments are privately placed and therefore narrowly held. That could be another reason why we don't see much of secondary market trading. There are many issues that just that explain why we do not have much of secondary market liquidity. We can address some of those issues. If whether or not they add significantly to secondary market, they can add significantly to the overall development of the corporate bond market. Where are we? Any market cannot develop unless you have its supporting markets. And the supporting markets for interest rate market is, for example, government bond market. Development will be constrained unless you have, let's say, the derivative markets in place where people can manage their risk, or the funding markets like repo markets. Now, government securities market has evolved a derivative and funding market over the years. We have a fairly, not the best that is available globally, but we have a fairly liquid interest rate market, mostly OIS, but globally everything is shifting to OIS, it appears these days. We are starting off with swaptions. That market is also taking off, not many, but a few corporates are showing interest in that market. So that could be another way of managing risk. We have instruments like futures on exchanges trading as well. So interest rate markets are broadly in place. The thing about corporate bonds, it has two significant risks on it. In fact, if I remember right, I remember someone telling me that why is it difficult to trade corporate bonds in the secondary market? Because it has two risks. It's easy to trade a government security because it has a single risk. It has an interest rate risk. I just take a view on interest rates. I don't need to worry about other things. Corporate bonds have credit risk as well as interest rate risk. So to trade effectively means take a position on both risks, which is not very easy in terms of trading. To enable trading in the secondary market when two risks are present, you need to shut out one risk. You probably need to keep away one risk. On the interest rate side, you can do that, but on the corporate, on the credit risk side, you can't. We have tried since 2011. I think we have in place the CDS, regulations. Market hasn't really taken off. Again, what everyone felt, including me, is that this would really take off if we can, have netting legislation in place, because that is the biggest obstacle to the development of this. Government has passed the netting legislation. It's of course early days, but hopefully that that will be a big fillip to the active management of credit risk implicit in corporate bonds. Reserve Bank itself has done a bit through regulations by allowing any regulated entities, whether it's NBFC or primary dealers or insurance funds or anyone, to act as sellers of risk under its CDS recommendations. So CDS regulations. So that would probably also help a little bit in terms of market making. Honestly, I haven't really seen much market making. I'm talking of the interest rates. I'm not talking of equity. There is of course a completely different ecosystem there. But in terms of interest rates, I mean, the only market makers effectively are either banks or, to a limited extent, primary dealers. So it is difficult to imagine in India a situation like what happened in the US. I mean, this of course was taken to one extreme, where insurance companies were taking on a large amount of risk on their books, credit risk on their books by selling products. It's difficult to imagine such a situation in India. Of course, no one wants insurance companies to take on risk to the extent that you end up like AIG did at that point in time. But then that is an important source of risk that is required in the market if CDS market has to develop. In terms of repo markets, everything has been done. There is a platform has been put in place. SEBI is now working to get a central counterparty. Probably the approach of central counterparties have been a little bit too, what should I say, defensive in terms of corporate bond markets. In fact, even in terms of government bond markets, I was told the other day that the margin on a floating rate bond initially was 25%, was brought down to 15%. That appears to me to be just too defensive. We have to be realistic. Keep a margin of 25% won't really help the repo market. So we probably have to do something about that on the corporate bond market side. SEBI's efforts hopefully will yield some result there. Broadly, I just wanted to say this much, with the main issues that we need to address. I'll highlight a few of them. One is the rating profile of the issuances. Look at the profile of issuances. In terms of the number of issuers, about 22% were AAA rated. I'm talking of 21, 22. About 29% were AA rated. Only 5%, 5.3% were non-investment grade. Look at these numbers, this percentage in terms of not the number of issuers, but in terms of value, it is a lot more skewed. About roughly 80% are AAA rated, and about 1.5% were AA rated. The percentage for non-investment grade is very, very minuscule. This is an issue. If you have mostly AAA rated issuance in the bond, the need to develop credit risk markets also reduces, because they need to manage the credit risk of AAA bonds is far less than that of, let's say, junk bonds, the non-investment grade bonds, or the lower rated bonds. So that is one aspect of it in terms of market development. But the more important aspect is that not having access to corporate bond markets by lower rated entities tends to undermine the financial stability role that corporate bond plays, because everyone then, banking appears to be, the banks appear to be the only source for them, for lower rated corporates. Lower rated corporates do not have the choice of going to a bank or a corporate bond market. Now, that is an aspect that we need to address. How do we address? We'll have to put our heads together. But that is an issue that would need to be addressed if corporate bond markets actually play the role they are required to play beyond the highest rated borrowers. Mode of issuance has, but that mostly it is privately placed and not publicly issued, has played a role in terms of contributing to the illiquidity of the market, because that makes holdings extremely narrow. Very few people hold it, which in general is not very conducive to an active secondary market. Having said that, I think we all need to think long and hard on why, despite so many efforts, that there is a very clear preference by the issuers to go to the private placement route. We need to understand that. We need to see what are the incentives there and create similar incentives on the publicly placed issuances. We need to alter the incentive structure to move people away. I really don't think regulation will help much without creating a lot of disruption in the market. We need to address the incentive structure that is there. We need to understand how much we can do in terms of shifting away. There are very clearly advantages of private placement. I want to borrow in a week's time, I would be able to borrow through this route. Going through the public placement route would take a lot of time. It has a lot of flexibility. But then, it also has its negative impacts in terms of secondary market liquidity and so on. This is an area, I don't have an answer, but this is an area that we also need to focus on. In terms of investor profile, as I said, there is a chart which shows that it is mostly institutional, hardly any retail, investors in this. We probably need to focus a little bit more on how to attract retail investors into this sector. I mean, the only retail bonds that I see, there are of course buyers, but great interest is when government issues those tax-free bonds, through those government entities. Sometimes they are, they're an excellent bargain, so people put in a lot of money, but those things come off and down. In any case, they are hardly traded. We need to look at how to get retail interest on a more stable basis into these markets. We also need to see, given the fact that this problem is almost similar to what exists in the government bond market. You have domestic institutional investor base, which is largely full. If you want to widen the investor base, you either have to go retail or you have to look to offshore investors. The same thing holds here as well. How much of that you can do. One interesting fact here, that comes out is globally mutual funds are retail sources of investment. But the debt mutual fund investment in debt mutual funds in India is again overwhelmingly institutional. So some of these issues that we need to address, how do we address the investor profile, broaden it? Another aspect that we need to address, not in terms of it's something that is not desirable and should be avoided, but in terms of how do we how do we sort of make that agree with our efforts to develop the bond market? Of late, there has been increasing tendency to move outside for borrowing, raising funds. This is understandable. There is a huge amount of liquidity outside. Rates are low outside. So economies are also getting more and more integrated. But there are a couple of things in this trend that we need to bear in mind, which we need to think about. One issue is that ESG bonds. Now, globally, this is an area that is likely to keep developing and developing strongly. We have to have ESG issuances in our market if going forward, we need our markets to keep pace with the rate at which it has developed in the past and how it will develop going forward. What that requires is basically, there are international standards. What it requires is greater transparency in issuance, credible checks against things like greenwashing, including arrangements for independent audits or, basically a robust taxonomy for these bonds. Globally, it exists. I think government's announcement that we will go for green bonds this year will help in creating a pricing benchmark against which our markets can also start issuing domestically. But this is an area that I think we have to think about implementing so that all ESG investments that happen does not happen in another currency outside of our market. This is one aspect that we have to keep in mind. The other aspect is not as important, but capital bonds. We are now seeing Indian banks accessing offshore markets for capital bonds. We probably need to look at what exactly are the factors that is impeding the issuance of capital bonds in India. We need to understand whether those factors are in tune with with the global features of these bonds. And we need to ensure that those bonds are also, they get issued not just offshore, but also onshore. These are some of the issues that I thought I would highlight. Other not as important issues, but there has been a lot of feedback to the Reserve Bank on this, is that despite having a system for trade reporting, despite having a system for primary issuance, through platforms and all that, there is a feedback that transparency of pricing, both primary and secondary, transparency of transactions, both primary and secondary, needs to improve. There are features that exist in bonds which you do not get to see, and therefore interpreting pricing there would become an issue. Now, this is an area that we can do. This is not too difficult to do. This can be a low-hanging fruit that we can take up because the system already exists. We just have to decide what are the important aspects of a trade or a transaction that needs to be made transparent. The other aspect which Khan Committee had also raised substantially are valuation. I don't think we have got anywhere on that valuation. It's not an easy thing to settle. I am facing that in terms of valuation of floating rate bonds in government securities. Just the issue of valuation in government securities is the fact that if the behavior of market participants to buy or sell or at what price to buy is being influenced largely by the valuation methodology we have there. The market bodies are looking at it and seeing how to settle that, but valuation can be very important if you want secondary market. People have to believe the price. the price at which it goes in books have to reflect the economic realities. If either of these things do not happen, it is very unlikely that we would see much of a much of a volume in the secondary market. Let me conclude now. We have made impressive progress in terms of corporate bond markets. Several high profile committees have made their recommendations. All the regulators and government has taken important steps to facilitate this. Product diversity is improving, market is large and growing, sophistication is also developing. Secondary market volumes are lacking, but not so bad when you compare it globally. Market infrastructure, as Neeraj, as Nilesh, told in his this thing is the best in the world. Not among the best in the world, but clearly the best in the world. I really don't think there is any other country, any other market where you would get a bond by bond trade with price on a real time basis. Not even in the most developed markets, you don't you don't get that. We should not play down our own our own achievements. Not very far back, maybe 4 or 5 years back, I was meeting someone on in the context of investing in Chinese government bonds. So I told them, fine, where do I see the prices? And they come back and say, you ask us. Now, this 2015, we have been having every single bond price available from 2005. So in terms of systems, we have the best. We really need to do much that way, but we need to make efforts to diversify the investor base, work out strategies through which corporate bonds can seep towards the lower credit rated entities. All other efforts we need to maintain. Yes, corporate bond markets are comparable to our peers elsewhere, but we need to keep developing, especially with the with the global scenario changing. There is a shift away towards ESG issuances and all that. We need to ensure that we need to catch up. All that we need to do. As much as we need to take these steps, it will serve us well if we temper our expectations on the degree of liquidity in the secondary market, secondary bond markets. If international experience is anything to go by, the best we can achieve in terms of liquidity would still fall far short of the liquidity we are used to either in the equity markets or in the government securities market. I think temper our expectations, identify key issues, should be there. Thank you.
Our honorable keynote speaker, Shri as a token of appreciation and also for taking time. Thank you, Deputy Governor, Shri T. Rabi Shankar and President Nilesh Shah. Panel 1 discussion on debt market, past, present, and future. What can we learn from the past to create a vibrant debt market future? May I now invite on stage our moderator for panel 1, Ms. Latha Venkatesh, Executive Editor, CNBC. And our esteemed panelist, Mr. Neeraj Gambhir, Group Executive, Axis Bank. Mr. Jayesh Mehta, MD and Country Treasurer, Bank of America. And Mr. Nilesh Shah, President, BCCI and Group President and MD, Kotak Mahindra AMC.
Working. Thank you, Bombay Chamber of Commerce. And thank you very much, Mr. Ravi Shankar. Uh, you've made things easy in two ways. Actually, in the first place, I'm wondering if we even need the panel because it was such a comprehensive presentation. But I'm sure the way forward that you spoke about is something people can talk about. The second reason why I should thank you is the way you ended it. Temper your expectations. I would extend that to the suggestions of the panel as well, because of the nature of the problem itself. And for the considerable time at which we have been at it, good to know that other countries have also not made too much progress on this. Okay, the format that we have decided in consultation with the experts, with the panelists, is that they will speak for a few minutes. We agreed on 3 minutes, but they are free, of course, to reduce it. Let's not increase it, because my suggestion is that my expectation is that there will be questions from the House, and therefore more can be explained or debated during the Q&A. But an initial set of comments will help so that we gather the threads as to what are the discussion points. Again, with the help of the participants, I thought we could divide the main themes as participants, institutions, infrastructure, and regulations. We probably can look at it in that fashion. So participants, I guess, mutual funds, insurance companies, provident funds, corporate treasuries, trusts, all these could be the eligible participants, but we don't see so much participation. So on that note, Neeraj, since this actually was your idea, let me start with Neeraj.
Thanks.
You're of course free to address all the four, but if you want to start with whether we can expand the participant base, before we get the retail, can we get more out of the other participants?
Okay, thanks, Latha. First of all, thank you very much, DG Ravi Shankar, for an excellent mark-to-market of corporate bond market. I think we haven't done that in a long time. And I want to add a little bit to that mark-to-market to say that if I look at, and you talked about the need for a bond market. I have a very firm belief that bond markets exist for non-bank financial institutions. We don't need bond market for banks. Banks typically do relationship lending. And you also mentioned almost something similar, saying that it's basically the non-bank financial investors who need bond markets or who can help us diversify the risk of the financial system. And I want to just put that in the perspective in the Indian context to say that if you look at the total banking system, advances, it's roughly 120 lakh crores today, 116.7 to be precise. If I look at the size of non-bank financial investor base, insurance companies about 40 lakh crores, mutual funds debt portion about 13 to 14 lakh crores, 13 to 14 lakh crores, provident funds roughly 6-7 lakh crores, NPS is now 5 lakh crores. And then there are trusts and there are multiple other constituents. So put together, the size of non-bank financial investor base is today, I think, somewhere around 70 to 80% of the banking system's advances books. Now, bear in mind that banks' advances have over the last 10-15 years shifted in favor of retail lending. So I would guess that somewhere close to 50-60% of this advances book is retail. So actually, if we talk about corporate borrowing from the banking system, the size of the bank lending and the size of non-bank financial system in India is almost reaching parity. And that's a huge change for our financial system. So we are actually steadily migrated into a kind of parity between bank and non-bank financial system as far as corporates are concerned. The second point that I wanted to make was that you are indeed right. Primary market has grown by leaps and bounds. You mentioned ability to price 3,000 crores in a day or 2 days. We actually did the latest HDFC Limited issuance, single transaction of 11,000 crores. That's kind of reaching the size where government bonds, single tranche is happening. And 11,000 crore is not a mean amount. It's a meaningfully significant amount for any investment. So I have only 3 minutes, so I'll just use the next maybe 1.5 minutes to bring out a couple of points where I have a little bit of divergence from your views. The one is in participants. I feel despite the size of our participant base, we still have very restrictive regulation on participants. You mentioned that all the regulators have taken a lot of steps to encourage the investment in corporate bond market. I feel that the large base of participants, which is the insurance companies, provident funds, even trusts, we have a very mandated format of investing. 50% has to go to government, 20% has to go to PSU, X% has to go this. We have to now take the bold step, and it's a politically difficult step, a bold step, to move towards indexation, index-based investing, and index-based return giving. A lot of the incentive to participate in the bond market in an active way will come from there, not by just nudging them to invest in corporate bond market. That's my firm belief. The second point that I wanted to make was, somewhere along the line, we haven't encouraged these investors to actively manage their portfolios. Case in point is, LIC does not participate in secondary market. Large provident funds, EPFOs do not trade in secondary market. I agree with you. Secondary market is no panacea. We should not look at secondary market to judge the size of a primary market. But if we don't have these participants in an active way in the secondary market, the price formation is twisted. It's not absolute in that sense. And it cannot help the primary market. So a lot of transparency issues are basically self-inflicted. If you don't participate, how will you know what's happening in the market? So that's my second point. I think, and I will conclude and I'll hand it over to the others. You mentioned that we should temper our expectations around secondary market, and perhaps it's impossible for every bond to trade and there will be a price of every bond. So my sense, as somebody who has been participating in this market for a long time, is we have a good secondary market. If for a given bond, I can find the price. It need not have traded. If I have a reasonable degree of confidence that if I go to the market and I will get a price at which I will be able to transact, that to my mind is a definition of a good secondary market. So with that, I'll pass it back to
Is
Latha.
that impeded? You're not able to
It
find
is
a price.
impeded. I mean, it's impossible today to, sometimes.
Impeded for want of buyers, or it is impeded for want of an understanding of valuation.
I don't think
Or
it's the
agreement over
I don't think it's the
valuation.
understanding of the valuation. I don't think we should misjudge or underestimate the intelligence of an investor. But I think it's the lack of a wider participant base in the secondary market, which basically.
That's some initiation into participation or participants. The next category was products. Now, I don't know if you want to address that. Nilesh, you're free to say anything. But Neeraj pointed out to the fact that corporate bond market is, or issuance by corporate bond market is almost equating bank loans to corporates. That's because a large part of bank lending has gone to retail. Now, why is not that not coming into the corporate bond market? For instance, MBS. I mean, we have excellent housing finance companies, and that has the best collateral possible. We should not have had logically problems in having an MBS, but it's not even initiated. So products would be my request, but you can speak on anything.
Sure. So if we look at a motor car, if it has 5 gears, it runs smoothly. Our government securities markets are liquid in secondary because there is central government securities, there is state development loans, then there are government guaranteed institutions issuances, both at central and state level, and then there is public sector undertaking. Effectively, they all have the same credit risk with little bit of variances, and hence there is price differential available. But in corporate bond market, as DG mentioned, you have large issuances of AAA, and very little issuances of below AAA. Now, how do I excite retail investor to come into bond market? Either it should have non-transparency like a gold market, where you can park bulk of your black money. Now, obviously, that's not desirable thing. Today, the investment in gold, no one knows what is the quantum. Now, because of lack of transparency, gold market is getting away part of retail savings. The second thing is, can I create risk return matrices which will attract retail investors to bond market? I'm unable to slice the risk pattern. Suppose if there is a double A rated issuances, can I create a structure where some part becomes AAA, some becomes double A, and some becomes A minus? And then there is a differentiated pricing. I'll get conservative investor, I'll get aggressive investor, I'll get super aggressive investor. And today, if you notice, this we did a Google search on collective investment scheme. 1.5 crore Indians have lost 1,80,000 crore in collective investment schemes in last 2 decades. And this is Google search. It is not an official database. Why are these people losing money? Because they are given 2% return, 4% return per month. Now they get lured by promise of excess return. Can I create a bond market where in a reasonable manner, I can provide excess return for higher risk taking, lower return for lower risk taking? If I can do that, I'm sure retail investors will step in. Now, the second thing which differentiates us vis-a-vis rest of the world, rest of the developed world, a lot of HNIs there leverage their investment in debt market. It is through structured note or it is through direct borrowing in the market. Most of the private banks' business actually runs on providing leverage to their customer. In India, leverage for HNI is virtually no-go. Neeraj did mention that retail lending has increased, but that's more for housing loan, personal loans, auto loans. It's not for investment. Now, if I can provide leverage to HNIs at the shorter end, and where they take the risk of mid to long end, their returns will go up without necessarily taking credit risk. And again, I can get investors into the market. So I provide leverage. I provide slicing of risk in a manner where I can meet risk return appetite of larger set of audience. Participation will increase.
But is that leverage forbidden? I mean, after all, banks, non-banks provide leverage when you want to play in the equity market. Is that lack of leverage the reason why HNIs are not coming into bond market?
So look at the irony. A bank will lend against shares about maximum of 20 lakh rupee. And on top of it, there is a capital market exposure limit. If you go into the NBFC market, your lendings will be upwards of 14, 15, 20%. But the same retail investor, if it goes in futures and options market, he's borrowing at 6 and 7%. A retail speculator on the floor of exchanges today borrowing money at lower rate than the government of India, sometimes. That's the irony of our market. Because exchange markets are more efficient, there is a shorter duration, and hence this low-cost funding is available. If I can deepen my bond market, the benefit of lower cost will come to the corporate borrowers, and yet higher return will flow to the investors. What we did on equity derivatives, we need to do it in the debt market.
So basically, is it not a chicken and egg situation? Because it's not developed, there are not enough participants, both lenders and borrowers.
So
would that be correct?
In some sense, you have to throw darts and you never know which one will stick. And as DG mentioned, we went to RBI saying that you introduce repo, bond market will take off. Now it didn't happen. Fair enough. Do something else. And you never know what will click unless until you experiment with it.
Okay, I'll come back with more questions, but initial thoughts from you, Jayesh. we were going with regulation, infrastructure as the two other unaddressed issues, but you're free to address any issue. And when we were chatting before the conversation, you had strong views on junk bond market and why it's not coming up. So you're free to address any of them.
So thanks, Latha. And as DG covered almost everything, and this is the first time we are actually going with practical reality, and it's actually a fact, right? We straight away compare our bond market, both primary and secondary, straight with US, right? To compare with any other countries, whether it is developed, emerging market, we are far ahead. We are reasonably ahead on that. So that's number one. Secondly, sitting here, we feel that there is bond market, junk market, other bonds do trade. It's mostly the IG which trade. Even that, I can tell you, when there is a stress situation, the IG there is more illiquid than the IG here in India. Like in recent times after the Russia war, all your dollar bond issuances which were done, not only India, any other. So I'm just giving you in comparison with India. It was the same rate. You will have the corporate bond in India for XYZ corporate trading at say maybe 7.5% in India. There it was trading at 7.5% in dollar. Okay, so that was, and some of the capital bank capital bond, as DG said, right? It was trading at the same rate. One of somebody did before you, right? It was trading at the same rate in the offshore market and on the onshore market. So that's where the difference is. I think so. That's what we have to become pragmatic in our expectation that where we are. Now coming to, and that's globally also, it will be the IG. So in our case, it will be the AAA or maybe AA, which will really trade. The rest of them will actually, even for mutual funds, it will fall in a different segment. I think one of the thing which started is the credit bond, like FMP, Nilesh, we are the first one to actually start the first FMP where we put actually some high risk credit into it, right? And then it became a regular feature, but that was a good product. But then some of them in between started doing credit bond, which is, if you really look at it, this structured bond or non-IG grade, right? Actually, it is more like a private debt. It actually falls in category with private equity in terms of liquidity. So it's actually lower than equities in terms of, the liquid funds, government bonds, corporate bonds, equity, and then private debt and private equity. Private equity, nobody expects maturity date. It would be around 3 year, 4 year, whatever it is. Similarly, private debts should have been that way. The problem really happened, these credit funds were having daily redemption available. It was good when the AUM was growing. The moment AUM started shrinking, that's where the liquidity problem came in, because this is private debt, just like private equity. Today, if you are private equity in one of the unicorn or anything, howsoever, whatever is your valuation, how liquid that would be on daily NAV? You can't. You can do it for the. So I think that's the basic thing. Now coming to even the investor base, we can't really have secondary market. If you really look at it, we have, I jokingly say we have only 15 investors. So like mutual fund, I'll touch upon that, because mutual fund and direct investment, I always consider as same. But if you remove liquid fund, there's hardly anything which is on the debt side of it. Then you have insurance company, maybe 2 or 3 insurance company, 1 or 2 insurance company, basically almost 75% of the insurance market. 3 large provident fund will be almost 75% of the insurance market. And I'm saying on the outer side, banks not more than 8, 9 will be 75% of the banking segment, right? So basically you have a 15-player market, which is more than 75%. How do you expect secondary market investment trading to happen? And again, 2 or 3 of them don't mandatorily are not allowed to provident funds and all that. They are not really allowed to trade secondary. So you really won't have a secondary market in that. Now for that, how do you widen the investor base? So either it's, when I say mutual fund, I put mutual fund and retail in the same category. And then of course the foreigners, even for foreigners, we did try, we have opened it up, but I think coming back to the retail and mutual funds, why? Because I always used to say, I used to have that theory that to change at times, which is 7, 8, 9 or 8, 9, 10, which is like 7% Government of India bond, 8% NTPC Reliance bond, and 9% SBI deposit. Where will you put your money? It's very clearly no brainer at 9, 10% deposit. Why would somebody put even in equities? Maybe at that point of time, Nilesh Bhai would say 13 to 15% with risk. Why should any investor? So while we are all talking corporate bond market, you remove FPIs from equity. What is the retail participation in equity? Nothing. It's only in last 3 years, where 4 years, where consistently the deposit rate is below GSEC. That's when your financial market people will be incentivized to move. In fact, today, we were talking about, yesterday we talked about roll down maturity on state government bonds and all that. Daily inflow is coming, daily. So people are looking at, in fact, 7.5, there are a lot of people who missed it because they thought, the government bonds will actually go to 775, 8. Now it goes to 740 also. I think they will come back to that market big time. So there are retail investors who are looking at, why are they looking at it now? Because deposit rates are much lower. So I think that's a structural challenge, right? Your AAA bond, I'm just putting AAA bond as a benchmark, right, is actually was trading actually at lower than deposits. So I think deposits should be more of a service industry rather than but of course people will have different view. But this is something I don't know how do we resolve that. As long as deposit rates are going to be higher than corporate bond, there is no way your financial market is going to be developed. Even if it goes back to above corporate bond, even your equity flow will start flowing down.
For the last 3, 4 years, my mother has been cheated. Okay. She is earning much less than the inflation rate. You want that to continue so that the corporate bond market will grow. I am
No,
not on your side.
so no, no. So inflation. So okay, let's address the issue really. Like FD is not really the inflation bidder. Yeah, you have to have small savings. You have small savings, right? Small savings rates can be subsidized. There is how small savings. We had postal savings, so many of that. And today it's a complete myth. Oh, small savings rate, we can't reduce FD rate because of small saving, because that's giving a higher return. It's a complete myth. 1,20,000, 1,65,000 crores deposit market versus small saving 20 lakh crore market, of which 12 lakh crores is a compulsory saving. Is it really a competition? Not really. How will anybody put, if I'm getting 10% in NFT or maybe higher, and if I go to Nilesh, I'll say, oh, I will buy AAA bond, I will buy maybe add some A plus and all that, maybe I'll give you little lower. Why would I put money there?
No, no, I take your point. The small savings argument doesn't work. But at the same time, all I'm saying is that just because we want to, no, you can, but which is the instrument that the large mass of India, go to, where financial literacy is at its lowest. There is a large category. And so I don't think politically it is possible, or practically it's possible to wish away the deposit as a product. It will continue to be popular. Okay, let me come to the other issues that we can discuss, which you all have raised. Neeraj, you spoke about the various participants. Now, mutual funds. Mutual funds obviously is a big category for corporate bond market, and in spite of some accidents like Templeton or other issues, FMPs, that market has a tendency to bounce back as a participant. Do you think there are any legal or regulatory restrictions that need to be removed? And likewise, you also spoke about LIC. I guess both of you alluded to it. Is it that LIC should be nudged into selling short and buying long? Are there rules which prevent it? Can there be regulatory changes that can be made?
So two different sets of participants. Mutual funds, I don't think there are any regulatory inhibitions for them to participate. I think the question is, what does the mutual fund investor want from the mutual fund? Do they want safety and security equivalent to a fixed deposit? And that's what the mutual fund is designed to return. In that case, they will be naturally veering towards very short dated and very safe instruments. We did experiment with the credit funds. Templeton was the pioneer in that sense, in that space. But we did realize that credit funds mean taking credit risk, and credit risk can blow up, and it can blow up quite badly. So that understanding, and how do you marry a product like that with a daily put option in the hand of the investor, which is what the mutual fund is giving, is the biggest conundrum that we have, that all mutual funds are dealing with today. So either we design a product where we say that, okay, you want to take credit risk, be aware of the fact that it means that things can go downhill, as it happens in case of any credit product. Banks have suffered that, so any credit investor will suffer it. But if it happens, it doesn't mean that I'm going to give you your money immediately the next day if you ask for it, right? There is going to be some time frame. And globally, people shut down their schemes when there is a big draw of the
Credit event.
schemes. Yeah, when the credit events happen. As a result of Templeton, I think side pocketing has been now permitted. I think that's a big innovation that we've come up with. We need to see how that plays out over a period of time. So I guess on the mutual fund industry side, I think things are evolving towards a much more maturer, both mutual fund industry as well as the investor base.
Daily valuation needs to be done. You would think, is that an institution or a practice that has
It's
to
a-
improve, because you cannot give out daily AUM when,
It's
daily NAV.
it's a bit of a chicken and egg story, in the sense that if you don't have the market trading on a daily basis, how do you give a price which is a meaningful price? And if you don't have a meaningful price, how do you have a meaningful NAV? I think that's a big challenge for a mutual fund manager to tell the investor that this NAV is indeed the NAV at which you can, convert your assets into cash. But it's a universal problem. It's not a problem just for India. I think like I said, for me, the definition of secondary market liquidity is, can I sell the stock at a price? Can there be a price in the market at which I can exit? That we don't have today. The one issue with the mutual fund industry, which I will leave with Nilesh Bhai, is that do we have enough capacity in the mutual fund industry to properly evaluate the credit risk, right? Because today banking system runs large credit risk on the back of very big departments. There are like army of people who are evaluating credit risk and basically approving credit risk and taking steps in case things go wrong. I think mutual fund industry is still very skeleton in its fund manager base and its analyst base. So do we need to invest more there? Right.
No, I take your point. Actually, why don't we just
Just
develop
leave
that
that
issue?
with
Since it's a very important issue, I'll come back to you for the other
Yeah,
issues
sure.
that you raised. But Nilesh, this is a fairly important institutional development, which is entirely in the hands of the industry itself. Or is it? What would be the problems for you to develop a robust credit diligence, credit measuring in-house talent?
So if there is a need, we will hire talent and develop it. Unfortunately, because of the illiquidity in high yield bond market, running an open-ended fund was not appropriate. And Templeton did experiment with that. For a while, they were successful. And the liquidity risk blew out. In their high yield portfolio, credit risk didn't blew out. They have returned all the money to the investors and more.
So are you saying that if ILNFS and DHFL had not happened, I mean, ILNFS was really an outside risk. If that had not happened, probably we would have had a more
No.
smooth flow.
If not ILFS and DHFL, something else could have still gone out. As Neeraj mentioned, you are running an illiquid portfolio with daily put option. Some risk would have blown out, if not credit, liquidity, if not liquidity, global macro, if not something else. Even a run on the fund based on rumors could, derail you in a very short period of time. So now what we are trying to evolve is AIF structure where there are close-ended credit funds. They are being marketed more towards HNIs, and they are trying to provide higher risk and higher return. It's not at the junk bond level, but it is at the high yield bond level. Activity is slow, but I think post Templeton, everyone wants to be cautious. Now, in the AIF credit side, are we putting more resources? Answer is yes. And if we find that these things can work out, we can go further into getting the talent. And my feeling is that before we go into that, maybe it is time to provide leverage portfolio in mutual fund. Today, thanks to the floating rate bonds trading at a higher value than fixed rate, I can generate double-digit return in gilt market with some amount of leverage. Now, imagine a proposition to a customer that with full credit risk control, I can still deliver you double-digit return as long as your time horizon matches with me. And for in between, if you want liquidity, you'll have to take the price risk. I think there will be investors who will be happy to come in a close-ended fund, which are leveraged, or carry the price risk in an open-ended fund with leverage.
You all are planning such a product, or is there any
I'll need
legal
SEBI,
encumbrance?
I'll need SEBI permission to launch leverage debt fund. Now, maybe we can experiment with this, how this works in real life, and then take it on a grander scale. So in terms of regulation, I need change on leverage for, let's say, government securities and not on the credit bonds. I can't leverage on credit bond. That will be a disaster. And for high yield bond side, I can experiment on the AIF side. And then hopefully this credit market will develop without what we saw in Templeton side.
Sorry, pardon my ignorance, but at the moment you cannot raise leverage on the strength
No,
of your
no.
government bonds holdings. You would want that kind of a
Yes.
permission given
Yes.
by the regulator. Okay, now just an outside question, and I wanted to raise it when Ravi Shankar was there. I was hoping he would be there for a little longer. You know, I don't think what I'm proposing is going to happen anytime soon. But will that be a panacea for developing corporate bond market? That is one financial services authority as regulator, probably RBI as the monetary authority, and a banking regulator, insurance regulator, PFRDA, mutual fund regulator, or whatever, SEBI reporting into RBI, or whatever. Will that be, because then you can change rules for LIC. You have a common agenda for developing bond market, and the single authority, whoever it is, can drive changes in all the regulatory bodies together because they would be in a reporting relationship. Is that a panacea at all? Ideally, I should be asking Ravi Shankar, but in his absence, you think that'll help, Neeraj?
Tough question.
And very, very speculative, I agree.
To say that multiple regulator system is working frictionless would be not correct, right? We do have our own challenges at times. You see that a regulation is issued by Reserve Bank, not followed up by the other regulators, and then you're kind of banging the doors to say, oh, allow mutual funds, allow insurance companies, then we'll have something happening in the markets. I think that, yeah, that happens. But I don't want to go to the other extreme to say that if we have a single regulator, the market will suddenly flourish, because the issues are not just about regulation. The issues are also about inherent risk appetite, the participation by various parties, et cetera, et cetera. So I think we do need to have some kind, and I was hoping that the FSDC, Financial Sector Development Council, that ministry runs, is the platform where these issues are addressed. That if you have a platform where all regulators come in and say, okay, ABC is being done, and we'll make sure that there is a consistent approach across the regulators for that particular product, so that markets can take, for example, CDS, right? We issued CDS guidelines. For a while, CDS was not permitted to be traded by many of the other non-bank investors. So how do you develop a CDS market without that? So if Reserve Bank doesn't want to promote CDS market, if ministry wants to promote CDS market, and make sure that all regulators are aligned, everybody is issuing harmonious regulation, and all investors are simultaneously enabled to participate in the market, I think that will go a very long way.
So, I would say more than regulator, it is all also on the individual institution. So, of course, individual regulators also need to approve, as Nilesh Bhai was saying, on leverage, right? So that's SEBI's baby, whether forget leverage, even on the OIS, you cannot do it without underlying, right? So the cash amount has to be there. So to that extent, they need to keep that much of cash if they just want to receive OIS or something, right? So it's about leverage, whether the institution should be levered or not. So that is the individual regulator's prerogative. But more importantly, even if it is allowed, today our largest insurance company, by internal regulation, they have stopped trading, forget corporate bond. They have stopped trading in secondary market, even in government security. Okay, they don't buy or sell government security in secondary market. They do only primary and redemption.
They lost too much money trading
No,
badly.
they don't want that. So they never lost money, but it is just, yes. But yeah,
But it doesn't make sense. Why is such an internal regulation?
but the
There will
same
be-
the same thing is now your private insurance companies, they are doing one level further. They're actually going into derivatives, bond forwards, all of sort of things. They are doing it. So it is not that their regulator is stopping them. It is an individual institution now. That,
LIC doesn't.
yeah, but that's a 65% or 60%. I don't know what is the latest weightage of there, but that's almost more than 50% market share.
Clearly the regulators have to be on the same page. Do you think one of the impediments to this is that there is a DFS and a capital markets regulator in two different silos in the government as well? So the capital markets division may want certain things, but the DFS may not, may be in charge of the rules within LIC that you can't probably sell short. So are there too many decision makers? Is that the problem, Nilesh?
So as Neeraj mentioned, a harmonization in FSDC the best way forward. If
It's not.
out of coordination.
Actually, corporate bond was not on their agenda. So until now, it never got discussed.
See, if you look at from a primary issuance point of view, our bond market is as good as what we need. It's the secondary market where there are issues. And in terms of priority, is secondary market volume the most important thing? Answer is no. What we need to now focus is, can we reduce the risk premium in the bond market? Today, the gap between our short and long end is probably one of the highest in the world. Now, if my market deepens, can that spread narrow down significantly? I think it is possible. Second will be, can I use bond market to plug the misallocation of capital in real estate, in gold, in chit fund, collective investment scheme? Can I bring those money into formalized market? So if we reposition
That
instead,
would be a financial inclusion, financial literacy issue, perhaps. There are people over there using those instruments because they are not aware of.
undoubtedly it is financial inclusion and literacy and also rule of law. This collective investment scheme guy, when he's raising money, he's not under any regulation. He's operating below the radar. Gold has import duty, but not GST. Now that means we don't know where that end gold is reaching. So it's a complex subject. And instead of saying that we want to develop corporate bond market, if we reposition this, that I want to ensure that every retail investor does not get lured by greed and does misallocation of capital. And that capital getting formalized will help you achieve $6 trillion GDP growth funded out of domestic capital and reduce dependence on foreign capital. Then probably we'll move up in priority. And then this harmonization will happen much faster.
But, I want to come to this unified regulator or regulation yet again, because ideally, the government bond and the corporate bond should be traded on the same platform, isn't it? And be under the same regulator, I would assume, so that you have one common curve. The lack of that, the fact that authority is fragmented, regulatory structures are fragmented, is not that an impediment?
If you
SC, NSE, equity trades the same price, right? So I don't think platform should matter. So
no, if you look at the most developed market which is US, it has more regulators than India has. So they have SEC, they have Fed, they have OCC, they have CFTC. Each of these regulators are regulating the market. I think the model that they have followed is that you have a product, and for a product there's a regulator, and that regulator decides how the product is traded. You don't regulate the participating institutions. The participating institutions are handled by the respective regulators. So there is a differentiation between how the product is regulated and how the institution is regulated.
we have the same thing.
Not
right?
necessarily. In many places we have, for example, take the classical case of government bonds, right? In US, if you're trading government bonds, you're trading a security, and it is under securities regulation, right? So whatever happens with US treasuries is basically under the purview of SEC, because it's a security to be traded. So stuff like that differentiates us to some extent and maybe creates that friction. But I don't think there is any universally accepted good model. There are places, for example, in Japan, you have FSA, still you don't have as well developed corporate bond market as US has. So my point is that if multiplicity of regulators is here to stay for us, I don't think it's going away.
It's not the biggest hindrance.
And I don't think by addressing that we'll address the corporate bond market, What we do need is a much more harmonized regulation rule making across these regulators.
Just to add that, when we say corporate bond market in India, let's not forget it's a local currency, local bond market. When you are comparing that with US, which is the world market, any other local currency, when even if you say Korea is higher, it's not, everything is not local currency, local bond market. So we have to look at that in that perspective, local currency, local bond market, compare that with some of the developed world also. You will be surprised that we are far ahead.
Absolutely, I take your point. Even when Mr. Ravi Shankar was speaking, after all, the US Treasury market is the global market. It is the global currency. And because of that, yeah, the corporate bond market also has its advantages because it's a dollar market, which is everyone's currency, which is the international currency, and that gives its own depth. We should be running at the last 10 minutes of our segment. Okay, then I want all of you to give one or two suggestions that is imminent, important, and doable that we can advance the case of the corporate bond market.
So one, create a separate commercial dispute mechanism, settlement mechanism for corporate bond. Today, the biggest risk why I'm not willing to take credit risk is I don't know if my bet goes wrong, how much I will recover and when I will recover. So can we have a fast track mechanism for corporate bond settlement or dispute resolution mechanism? That's one thing. And second, how do I encourage leverage to the institutions and to retail investors so that the gap between short, medium, and long can be taken away by a certain set of investors to enhance their risk return?
Well, that legal reform of commercial dispute resolution is something which everybody in India wants, and we have not cut much ice. One thought if the IBC is set up, then there will be subsequent developments, but that's not happened, nor is it progressing with the way in which we expected it. But two great suggestions. Neeraj?
So I'll go back to where I started. A large pool of public money is being managed, which is your provident funds, EPFOs, are being managed on a very non-standard way in India, right? We need to move towards a global standard of how this money is managed, which is indexed, which is in the hand of professional investors, which have an incentive to maximize the returns, and the returns given to the investors are in line with the market. I think that's a huge step that we need to take. If it is taken, we'll have a very different looking corporate bond market.
It's going to be very difficult to tell the EPFO investor that your returns are going to be market determined, because now there is a popular expectation, a political expectation of 8 or 8.5 or some percentage like that.
I think in different parts of our financial system, we have accepted it. Remember, it was very difficult for us to accept privatization of insurance. It was equally tough task. We did it, right? So we do need regulatory and political will for it.
No, I take your point. Did we ever imagine that savings rate would go below 3.5%? And it came down to 2.75 as well.
No, and
It took time, but it happened.
We have to go back to history where Unit Trust of India gave guaranteed return, and eventually it required a huge bailout. And fortunately, their equity investments eventually funded that bailout. But should we repeat UTI again in EPFO? Answer is clearly no.
Yeah, that clearly is something we have to do in terms of EPFO participants. But bond index, is that so easy?
I think by indexation, I don't mean that you create a bond index and just follow the index. By indexation, I mean that the instruments that you invest in are basically the returns, you are basically benchmarked against market returns. You're not supposed to generate 8.5% fixed come what happens.
Okay. Jayesh?
So I will not complicate the matter. I'll go back to the basic. I still think we started with bond market reform and all that post Harshad Mehta scam mid 90s and all that, right? We done fantastic job on infrastructure till 2005-6. I think we have created the world best infrastructure, and which is really good. So I don't think we should really crib on regulators or infrastructure. I think what we have missed out is on the incentive. You see, and it's ultimately whether whichever form, provident fund, insurance, mutual fund, bank deposit, it's ultimately retail money. So where is that retail money going? It is going to the best return which is getting, right? And like, as I said, like when the deposit rates were not so high, there were project finance institutions, IDBI, ICICI. I have marketed their retail bond by advertising on double-decker buses in India, and people were buying, right? So that used to give 13, 14%, whereas your bank FD was 10%. People would buy. The moment you give them some attraction, people will come. Even your mother will buy, put money in Neeraj Bhai's mutual fund. If as long as corporate bond gives higher return, he's not going to take that money away, right? If AAA is giving higher return than a bank FD, logically it should be giving. But unfortunately, the India, it is not happening that way.
Well, suggestions from the house, most welcome. Anand, you in particular, since you are the academic here, and therefore you can't be accused of arguing for in favor of mutual funds, in favor of banks, in favor of insurance. Yeah. No, you can give this.
So my first suggestion was, though Deputy Governor Ravi Shankar has left, there must be people from RBI here in the crowd. In fact, I can spot some of them. Why don't you ask them some questions if the panelists want?
Well, if I
Want to ask Ravi Shankar?
No, I wanted to ask Mr. Ravi Shankar whether a unified regulator is the answer. May I know if anyone is there from RBI?
They seem to have left. I thought Siddharth was
okay,
here.
okay.
He left as well. Okay. One question, I guess, for all the panelists. We don't have a buyer of last resort for corporate bonds in India. Of course, we always manage to manufacture something through the back door, as we did in March, eventually last year. But, Khan Committee, several in 2016 had suggested that the RBI should start accepting corporate bonds, AAA corporate bonds, quasi-sovereign corporate bonds, maybe to start with, as part of
That was the question I was going to ask him. Are we anywhere close to?
that, today, if there is a systemic crisis and causes a financial stability question, there is no regulator willing to stand up and say, here I am to give a backstop to maybe PFC, REC, Exim, even those kind of bonds. Is there any progress happening on this suggestion from the SEBI on
That
backstop
SEBI was
facility?
planning.
So unfortunately, though it was approved in the budget at 30,000 crore capitalization, subsequently nothing has further moved to the best of my knowledge. And it's clearly needed. The buyer of the last resort is necessary in the market, especially when liquidity disappears or there is a run on rumor or something like that. So let's hope and pray that what was announced in the budget 2 years back will get implemented soon rather than later.
Any other questions?
Just taking on Jayesh's point on making debt returns attractive, why this stepmotherly treatment on taxation for debt vis-a-vis equity? Equalize it with equity and funds will already move to debt given the attractiveness of the post-tax return.
There isn't a representative who can take it, but is that a very big hindrance?
So if you give higher post-tax return, then anyone will take it. But when we issue tax-free bond at higher than taxable bond once in a while, it only distorted the yield curve. It actually resulted into misallocation of capital. So it's like chicken and egg situation. Should I make bond market as non-transparent like Indira Vikas Patra so that black money can move to financial product rather than gold? I might as well make transparency in gold market so that money actually moves to financial product. That will be a better way.
His question is, why are there different taxation rules for capital gains in equity and capital gains in debt?
Because you can't be converting interest income into capital gains. So the debate will be, should debt fund enjoy this tax benefit or not?
I would vote for yes, but what's your vote?
You are asking barber, do I need a haircut or not? Obviously, I'm going to say
Better
no.
part of retail savings are in debt through bank FDs, etc. We have incentivized equity markets enough for the last 30 years. I don't think they need incentivization anymore. Equalize it, either raise this or reduce this. That's the only question.
I think he has a point there. I
No,
do think
Latha,
equity is pampered more.
but in today, the retail ownership of Indian equity is about 9%. Do you want an India where all the ownership is with the foreigners rather than with Indians?
I would just add to that, whether it's equity or debt, I think when we compare debt, even on a post-tax, pre-tax return, right? My point was the same coming to FD, right? Or FD is also taxable. And in Bombay, we think about this tax arbitrage and all that. But if you really look at retail household, right? Anybody, if in a family, one member, typically in a family of four, will be a non-taxpayer, maybe a mother or wife or somebody, right? Up to 40 lakh FD, the tax is no different. And how much is the retail savings in India? One has to also look at it pragmatically. When we sit in Bombay, we talk about, HSNI money that can go through debt mutual fund. 3 years capital gains, you are getting it. There's no problem. In fact, there is a talk about capital gains should be there or removed for foreigners. And there is also an argument that if you remove for foreigners, remove for Indians too. So maybe do it both ways.
No,
Latha,
I don't think that will
one
be
question.
something the government will be willing. Yeah, please.
So again, to the panelists, the DG just said that, we should be content with the kind of liquidity that is there globally. And India is the second after the US in terms of liquidity. Are we content with that as panelists?
No, certainly not. I think uh, if you look at the amount of trading volumes and what trades on a daily basis, I think it's quite low. Even if you compare with what gets issued versus what gets traded, so like I said, I mean, nobody expects each and every bond to trade every day. It doesn't happen in any market. We anyways have large number of bonds outstanding. It's not the expectation, but the expectation is that you should be able to price a given credit with a reasonable degree of accuracy and expect that at that price you should be able to liquidate the asset, right? Now that's a very abstract definition of liquidity. What it basically means is there are buyers available at a price. Now you may like the price, you may not like the price, but at least you can exit the position. I don't think even in US or any other, developed markets, you have that level of liquidity where everything is trading everywhere. It's all boils down to, can I price and exit?
Well, I think we will. Oh, yeah, sure. Go ahead.
The differential in the pricing of risk in the loans market vis-a-vis the corporate bond market. If you look at the weighted average cost of loans, it's about 9%, whereas in the corporate bond market, for the same level of credit, it's between 9 and 11.5%. So is that an impediment in the development of?
We've been on both sides of this equation over the last 3 years also. I mean, not also last 20, 25 years, but 3 years itself, we've seen this, where bond pricing has been below loan pricing, above loan pricing. Both the scenarios have evolved. I think we need to realize that there is different motivation and different incentives for both loans as well as for bonds. Banking system has its own way of looking at things and pricing it. Not necessarily they're interpreting the credit spreads coming out of the bond market and applying that to their cost of funds to come up with the price for the loan. And I don't think that's going to go away in a hurry. It also exists in other markets. It's not that it is only a domestic phenomenon. It exists in all the markets. In many of the markets, if you have an active CDS market, that provides an input for the loan market to say, okay, how do we sort of take that in? But I'm not expecting this at times arbitrage to go away.
Well, we have to call it a day. It's time for the next panel to start. I think some worthwhile suggestions in terms of allowing more leverage or, ensuring that large institutions like EPFO are giving indexed returns. These are some valuable suggestions. And of course, the big one would be if one day Reserve Bank accepted AAA bonds in the LAF, perhaps that would give it a very big fillip. The backstop facility that we are awaiting from SEBI could be yet another institutional step.
Yeah, it is not necessarily like when we have stressed in 2009, they did take bank CD and
No, they did. as well, during stress times, the backstop arrives from somewhere, but they're asking for, normal times backstop facilities. Thank you very much, Neeraj, Nilesh, and Jayesh, and the very enthusiastic audience.
May I now request our Director General, Mr. Sandeep Khosla, to present a memento to our moderator and panelists as a token of appreciation on the behalf of BCCI. Thank you, DT sir. Thank you, Ms. Latha Venkatesh, Mr. Neeraj Gambhir, Mr. Jayesh Mehta, and Mr. Nilesh Shah for such an interesting and informative discussion. I am sure everyone would find this discussion extremely relevant and insightful. We are grateful for your time today. Moving on with our second panel discussion, role of debt market funding India's journey to $5 trillion economy. May I now invite our moderator, Mr. Tamal Bandhopadhyay, consulting editor, Business Standard, who is also an award-winning author. And our eminent panelist, Mr. Rajiv Anand, Deputy Managing Director, Axis Bank, Mr. Abhizar Devanji, Head Financial Services, ENY, Mr. Suresh Krishnamurthy, Senior Director, Market Intelligence and Analytic, CRISIL, and Professor Anant Narayan, Associate Professor, Finance and Economy, SP Jain Institute of Management and Research on the dais, please.
Hello, good afternoon, and very warm welcome to the last session, second session, role of debt market funding India's journey to 5 trillion economy. In the past 1 hour, 45 minutes, we listened to first the Deputy Governor and second, very interesting panel moderated by Latha. So one word, the entire summary, you can have this for 1 hour, 45 minutes. Either one 8-letter word or 2 word 11 letters, 2 plus 9. Illiquid. Market is illiquid or no liquidity. So not this 1 hour, 45 minutes that we discuss. It started actually from 2006. 2006 budget first spoke about constituted a committee, and H. Patil, former chairman of NSE, was heading the committee, and that looked into the each and every aspect: taxation, infrastructure, role of regulator, reluctance of buyers, so on and so forth. So actually, this 4 gentlemen and me, 5 of us, our predicament is that of Larry Fortensky. You know who is Larry Fortensky? I mean, he is a US construction worker, but he's famous for he was the 7th husband by 8th marriage of Elizabeth Taylor, because Richard Barton, she got married twice. Now it was in 1991 at Michael Jackson's farmhouse. They were their honeymoon, first night. And Fortensky knew exactly what was expected from him, but he didn't know how to be different from the past 7 husbands. So, I mean, what do we do, 5 of us? How do we be different from not only the past panel, but even this last 16 years, what all the discussions happen?
So I'll just start very briefly because you have come to listen to them, not to me. I'll just give a few facts, and I have a slightly different opinion about what what RBI Deputy Governor said. One more thing is this: we'll have questions while the session is on. So please keep the microphone on there, and whoever wants to raise any question without disturbing the flow, just raise your hand and ask the questions. One is this corporate debt market as we speak till June is 39.58 trillion. And if you see the entire bank credit market, which is still recently 123.7 trillion. But the corporate credit of it is 31.6 trillion. So factually, corporate debt market is much bigger than corporate credit market. Is it correct? Yes and no. Yes, because numbers say that, and no, because if you look at the entities who have been raising, these are all proxy government. The large part of it, I don't have the exact breakup, but the large part of it, lion's share of is all the state government undertakings. You know, the budget spoke about is this surrogate lending, the government debt, how it's been made, etc., etc. So nothing to get excited about it. And second is, as far as liquidity is concerned, he spoke about the percentage of GDP, but as far as liquidity is concerned, I think we are nowhere in the world. US corporate bond markets is far more, the trading volume is far higher than the equity market. And most of the developed nation, that is the scenario. And global average is this: bond market trade is 3 times larger than the equity market trade. Where are we? Nowhere. So I don't know, why we are so excited about it, that we are doing a great job and we are second to none, so on and so forth. We have a far, many miles to cover. And this is the two facts I raised to you. Those who are raising the bonds are primarily the government undertakings. That's the bulk of the volume. And second is, as far as liquidity is concerned, we are nowhere near the first world. So we will have some micro issues to discuss. As I said, the challenge is how to make it different. So let's just start with Anand. First, a bit of a preliminary remarks, 3-4 minutes. What do you want to see, how to take it forward, and how the bond market can play a dominant role in taking India to 5 trillion economy. And then we'll get into sectoral issues. Over to you.
Thanks, Tamal, and good afternoon to everybody. I think the focus of this panel, in a sense, is not so much about development of the corporate bond market. I think our 3 friends have done a wonderful job articulating what all we need to do and what we can do better, etc. It is really about funding the $5 trillion economy. And so therefore, the liability side, where is this money going to come from? Ultimately, the money first needs to come. It could come thereafter into multiple pools, could come to insurance or mutual funds or bank deposits and so on and so forth, and then get channeled into this $5 trillion economy, and therefore, all the funding that is required. And in a sense, the corporate bond market is only one pool, one conduit to be able to get money from the saver to the borrower, so to speak. So the question really is, yes, we have, if you see one of the data that has been quite shocking to me has been that the growth of household savings, just the absolute numbers over the last, I think 5-7 years, has been pretty much flat. And so therefore, if household savings are going, and thereafter within that, money is going into fixed deposits and homes and mutual funds, etc., etc. But fundamentally, that pool of money that we require to be able to fund still has not grown. The second aspect has been that corporate, the other pool of money that is available is corporate profits or savings. Yes, over the last couple of years, I think corporate profitability has significantly improved, including public sector entities, and hopefully that will begin to address some part of the gap that we have in terms of funding the $5 trillion economy. But I think that is the other pool of savings that needs to continue to grow. as we go forward. And of course, the last piece is overseas money, which to some degree is of a volatile nature. It is, I would argue, yes, pools of money in the equity markets have been around for for many years, but I think especially on the corporate side, they are in a sense fair weather friends, and therefore to rely on that completely is certainly an issue. And so therefore, if you look at each of these pools, and I think there are issues on each of these pools, and therefore how can we then ensure that this money is being channeled appropriately. I think Neeraj spoke about the fact that the ability of particularly people like EPFO and insurance companies, their ability to freely channel money is an issue, and some of those things certainly need to be addressed. But I think the focus really has to be on how do we increase the pool of available funds and channel through the various resources that we have across the capital structure.
And just one small technical question I'm asking you, that insurance companies and EPFO, they are not allowed to play in the secondary market, right?
They are allowed to play in the secondary market, but for example, the responsibilities that they have is quite onerous. If I remember right, they can only buy bonds which are AA and better rated, and they have to have 2 ratings if I remember right. And those sort of onerous responsibilities are there. I think the point that Neeraj was making is, why should these responsibilities be there? Like a mutual fund, they should be able to invest in the best possible manner to be able to optimize returns in an environment where they are able to manage that risk.
Okay, over to you, Abhiza. First 3-4 minutes.
Yeah, 3-4 minutes. So topic is, how do we fund that 5 trillion economy? The point I want to emphasize on is the fact that we have a great banking system, and Rajiv just highlighted the fact that yes, the inflows are coming in slower. A way to address that is, a bank, in my view, is a specialist organization which understands credit better, fundamentally, theoretically maybe. Now, if you look at that, what the banks ought to do is actually to fund the greenfield infrastructure growth in this country. And they could do, in the lack of household savings, actually try and churn their assets through the bond market. Now, if you look at a typical bank balance sheet, and 70%, so in terms of money management, frankly, 70% of our banking is 60+% of our insurance and PFO business is public sector banks. Unfortunately, the money is held with them. But whatever they may be, that money needs to be churned effectively through the bond markets, is my proposition. So you carry annuities. I give you an example. You fund the construction of a bridge or a toll road or whatever. You fund it during the construction period. That's your expertise. But at the end of it, when it turns into an annuity, you have to offload it in a bond market, which nobody does today. And is there a nudge or a requirement? I think there should be one. Because unless they churn their balance sheets around and offload those annuities into a bond market, we will not have a churning of cash and new investments coming in from these specialist lenders. And then, of course, to infuse liquidity, we should have the likes of the reservoirs of long-term capital, which is the insurance companies and the EPFOs, etc., to have a trading desk, which they can, as Jayesh pointed out and Anand pointed out. There's no regulatory issue. They should have a trading desk, like a bank has a treasury, to say, let us churn that cash enough, or let us churn that portfolio enough. And that itself will give you not only a AAA, which is biased today with government bond markets, but actually will give you, AA and below, which will establish the interest rate markets that we need to. Now, the other thing on regulation I would like to highlight, and this is a live example I'll give you. We were trying to raise money for a toll road monetization. And there were some risks in that. So we decided that we will put the rights to collect toll into an SPV. And that SPV will then have a right to collect the road. And then we said, let's place it in a bond market. So we went to the likes of Life Insurance Corporation, and they have an internal or external, I don't know what regulation, but some regulation, which says that you cannot invest in a newly formed SPV. It needs to have a 3-year track record. Stupid, because this toll road is existing for the last 10 years. But because of the 3-year track record, they could not invest. And guess what? We went back to the public sector banks. So the same public sector banks have now reinvested in a new form through a debenture in an annuity. So I'm just saying that where is it that we are churning that capital into actually making sure that the bond markets become vibrant? Now, obviously, all the infrastructure, as we said, is top class. What we lack is the liquidity. And let's get that liquidity. And if you look at the stock markets, I'm no expert, Nilesh Bhai is, but the stock markets also first generated domestic institutional liquidity. And that liquidity was given a fillip by the FPIs coming in and FERA dilution and all those things that happened at the right times in the market. We need good quality paper entering the corporate debt market first. And I think a lot of it is sitting in a PSU banks and non-PSU banks too, because they want to earn annuities, 4%, 5% savings rate, 7-8% yield on the annuity. And there's a nice 4% gap which people run. The balance is kept in government securities. So this is not banking. It's actually lazy banking to some extent. And that banking offload needs to happen into the bond market.
Thanks, Abhijit. So I'm not very sure the bankers present there, how many are there, whether they'll be very happy because you're using all the expletives and and also you have wanted to fire.
I've got a lot of things, but certainly not lazy.
Yeah. So, and incidentally, but probably public sector banks no more holding 70% of the market share. Probably it's less than 70%. And if you look at the incrementally, they are far, far lower. Private sector is far ahead, not only on the asset side, even on the liabilities. So you talk about that public sector banks are the proxy for sovereign. But if you see for every 100 rupee new deposits, I think about 20 odd rupees going to public sectors, close to 80 rupees going to private sector.
Sure, but if you look at insurance, all that in the public sector also, there's a lot of cash lying, within those people to invest in the markets.
Okay. Thanks, Avizar. I mean, on your right side, banker is sitting and you are doing all sorts of things. But we'll hear Anand after that. But before that, Anand, a banker turned academician. Your previous.
Thanks, Tamalda. Very quickly, and I know 3 to 4 minutes.
Yeah. No, then we'll get more chances.
Then we'll get more chances.
More rounds.
Yeah. So first, I want to repeat what Nilesh Bhai and Rabi Shankar mentioned, which is that I don't think there is a panacea, 3-4 things Karlo and everything is sorted out. This is going to be a journey. US did not become US overnight. It happened over 10, 20, 30 years, and it's a journey. Second, I want to emphasize what Rajiv mentioned about the importance of bond markets. People say that banks are in a better position now than they were 4 years ago, which is true. 2018, the gross non-performing assets was 11.2%. Today, as of March, it was below 6%, 5.9%. But banks have taken a huge beating over the last 5-6 years. A lot of this reduction in NPAs has come about because of write-offs, technical write-offs. 10.2 lakh crores have been written off for the last 5 years. Recovery from this has been minuscule. IBC is fantastic compared to the past, but out of the 480 cases which have seen a settlement, you only had 33% recovery after 2 years of fighting through the courts, right? So bankers have taken, by the way, lots of bankers are still in jail or facing charge sheets for no fault of theirs for having signed off on some piece of paper sometime in the past, despite the best of intention, including from the government. This is a risk-averse banking system today. Make no mistake.
Not lazy.
Not lazy, but risk-averse. And the equity markets actually reward banks which are risk-averse. Look at the price-to-book ratios of the risk-averse banks compared to anybody who has any kind of risk on their books. Now, if you have a risk-averse banking system, and if you have 110 lakh crores of investments to be made in infrastructure over the next 5 years, who's going to finance that? I can't see banks coming up, and by the way, they should not be. As Ravi Shankar mentioned, with short-term liabilities, you should not be, doing 15-year project financing, etc. It has to come from the bond markets. So I disagree with the deputy governor. I think bond markets in India have to grow bigger than the banks as far as corporate financing is concerned. There is no choice. We have to grow bigger. And therefore, a lot of the things about liquidity, depth, etc. is absolutely essential. Okay. Now, very quick points on some of this. First of all, I mentioned this point about buyer of last resort. If there is one market which is absolutely loverous, nobody wants to be a mother father for it. It's a corporate bond market. We do need somebody who can be a guardian for this market. Second, I completely agree with what Neeraj mentioned about institutional freedom. Rather than having prescriptive regulations from IRDA and PFRDA, etc., saying put so much of percentage on this, that is nonsense. Move away into what banks do, which is risk-based management. Let the institutional, the investment committees, etc., decide what is the best. Find and then let them compete with each other on the way they manage the risk and give the returns. Third, there was a lot of chatter. In fact, Nachiket asked this lovely question about taxation. Here is one question I would like to ask the audience here. Lots of people who understand bond markets. How many of you actually hold corporate bonds, not tax-free bonds, but regular corporate bonds in your demat accounts? I'm willing to bet it's very, very few. The reason for that is very straightforward. None of us salaried people, I'm a salaried guy, will ever buy a corporate bond, even if I understand corporate bonds. I get a far better tax treatment if I buy a debt fund, right? I get indexation after 3 years. I get capital gains after 3 years, which I don't get if I'm holding the corporate bond directly. So, to Nachiket's question, rather than looking for parity with equity markets, let's have parity within debt. You give me the same treatment for holding a corporate bond that I get if I hold the corporate bond through a debt fund. I don't get that, right? Now, reason why I think it's important, I think retail interest in corporate bonds is absolutely possible. We are a country of people who, there is a specific bunch of us who will do sattabas. We will trade anything that moves. Today, we are not trading corporate bonds simply because it is usurious in terms of tax to do any kind of trading in corporate bonds. You make it a level playing field in terms of at least having a decent taxation regime equal to what I get through debt funds. I'm willing to bet the brokers who trade in equity markets will also trade in corporate bonds. If that happens, it's great for the ecosystem as a whole. If you have 9 crore, Nilesh Bhai mentioned 9 crore investors in corporate bonds in equity markets. If we get half of that, if we get 5 crore investors in corporate debt markets, I can assure you what happens to mutual fund, debt volumes, what happens to insurance companies being pushed to do better investments. Everything will go up. By the way, Neeraj mentioned 13-14 lakh crores on fixed income mutual funds. Actual investments going into corporate bonds is hardly 2-3 lakh crores. It's not really, a lot of it is just liquid funds and overnight funds, which is hardly, a corporate bond market. So I think there's a long go on that basis. Last bit, I'll quickly add, lots of things that the regulator can still do. One would be, by the way, the secondary market volumes that we talk about as, being very, very high. Neeraj will know this very well. A lot of the secondary market volumes are misleading. They're actually primary trades which happen to go through the secondary market because they are dealt from before and then consummated 3 days later after the issue is done. So if you take off those primary trades which are masquerading as secondary trades, the actual volumes are very, very low. Plenty of things that we can do, including things like allowing bond shorting, allowing anchor investors to come into primary and corporate bonds, having a better system for market making, maybe have the large issuers come in and effectively have market makers, have established market makers. Lots of things that I think regulators can do to push up markets even now. It's not a panacea. I don't have one single solution which can help markets, but we definitely need corporate bond markets to move in order to be able to fund a 5 trillion economy, which I think has to be the brunt has to be borne by the corporate bond markets. No questions asked.
Thanks, Anand. Very candid and detailed within a very short time. You pointed out lots of interesting things. We will dissect some of them. Probably Abhizar can throw some light on taxation, etc., etc. I will talk. But before that, Suresh, over to you. I know you are from the research segment, but you are representing a rating agency. Deputy Governor spoke about the role of the raters. We'll come into that later, but first your preliminary remarks.
Sure. Thank you, Tamanda. I want to focus on a couple of aspects. One on the supply side as well and the infrastructure programs as well. The way we see it, we think only 70% of the NIP is likely achievable over the next 3-4 years, 5 years. So that itself puts a question mark over the journey towards a $5 trillion economy. So from that perspective, I think there needs to be a lot done at central government level, collaboration with the state government, and then also on the ESG and the green bond side. Without all of this coalescing and coming into place, this trajectory in terms of growth rate or infrastructure investment towards a $5 trillion economy is going to be difficult to achieve by 2027, maybe 2028 or 2029 is possibly when it can actually fall into place. Another aspect, I think on the liability side, there was a lot of discussion. Capacity building is also something that I want to highlight. Whether it is ESG, green bonds, taxonomy related capacity, in NCLTs, bankruptcy professionals, resolution professionals, credit risk in institutions like the insurance agencies. These are also issues that we need to tackle if this move towards a $5 trillion economy needs to materialize faster rather than later. Lastly, this was alluded to by my panelists as well, regulatory risk averseness. I mean, we saw what happened when the Templeton issue came about and how SEBI reacted, how the rules have changed in terms of the cash position that mutual funds need to hold. Similarly, on the insurance side, I've had discussions with the regulator, and clearly they are worried about investor and the returns and the safety of capital for the investors. So given the context of regulatory risk averseness, this ability of the long-term players in the market to finance the requirement on the infrastructure side is something that going to be difficult to achieve. A point about insurance, ability of insurance firms to invest in infrastructure segment. They've been allowed to invest 5% of their AUMs in infrastructure investments rated A or expected loss rating of 1. So already that flexibility has been given to them, but insurance players have invested only about 2% of the AUM in such securities. So, and that clearly is because of how regulator perceives the risk in these investments. So these need to be addressed. I mean, essentially from a pipeline of infrastructure program investments that need to be addressed, and then capacity building, and then regulatory risk awareness for us to move towards this $5 trillion economy.
Thanks, Suresh. Essentially, you spoke about the logistics and infrastructure of the market, right? We'll get into some finer issues, but any question from the floor? For anybody? We'll not keep it till the end. And this gentleman, please give him. We'll not delay your lunch, so we'll be very precise. 1:45 will end. So within that, certain issues we need to. Yes, please.
Just an observation. When you talk about this funding, this $5 trillion economy, some of the aspects which you have to consider include, for example, Canada has already invested $100 billion in India. Canada. And Japan already has committed $100 billion. And sovereign wealth funds from Abu Dhabi, etc., and pension funds, they are all looking at India in a big way. That's one. Second is, since we are growing at a very fast rate, our savings every year is going to also increase from the individuals. So that we can find out how to channelize that.
Okay.
And on top of that, we are the largest borrower from World Bank, Asian Development Bank, New Development Bank, AIF. You take any development bank, we are the largest borrower. So they are still interested in lending money to us.
Okay.
So these things can be considered.
Thank you. Anybody has any question? Yeah, there this gentleman. First, let him. So just observation we'll take on the lunch. So just question because we'll not get the panel, we don't get them every day. So any other discussions we can have over lunch. Let's have specific questions.
Yeah, so I wanted to pick up on the point that Rabi sir made. I come from the world of infrastructure, where our big problem is that the infrastructure debt funds have not been able to do what they would because the banks are holding on, to whatever good credit opportunities are there. What are some of the things that can be done to encourage banks to churn what they're holding so that can create the market?
Yeah. No, so I think what can be done clearly is one, there has to be a nudge from the regulator. Very clearly. There has to be a nudge, more than a nudge in my opinion. To say that if there are annuities, so there was a secondary loan market committee of RBI, which actually has put in place now systems, because one of the issues is when you go for refinancing, it's a loan to an entity. That entity has to consent to actually move to a bond market, first of all. So I think now the documentation, etc., is being proposed in a way to say that there is an implied consent taken from the person to actually go and refinance it through the bond market. Secondly, I think banks will need to have, and RBI needs to insist on that, on documentation which says that there will be mandatory movement to the bond markets. I think that is really required. Just to also, tell you, Manish is an infrastructure expert. We used to work together earlier. But just to tell you, there is no dearth of capital as far as infrastructure is concerned. Whether it is long dated capital or short dated capital, whether can banks fund mismatches? I think the banks have the ability. They have been funding mismatches in the past, and I'm sure they can fund mismatches in the future. The problem with infrastructure, in my view, is the credit risk ability of a project to go through, because we are not able to deal with the risk aspect. See, even today, we are setting up all kinds of organizations. We are now announced an infrastructure bank, and we had announced every other thing. Everything talks about supply side of money. Supply side of money is not the issue. The credit guarantee is a bigger issue, whether somebody can even provide one. I don't know, maybe Rajiv can add more to it.
So I think the environment for infrastructure financing has significantly improved over the last 5-7 years. If you look at roads, for example, the evolution of HAM structures has made those projects more bankable. On the power, particularly on the, nobody does thermal anymore, so we won't talk about thermal. But if you talk about renewable, the fact that you have NTPC and now SECI on the other side as a counterparty rather than state discoms who are for practical purposes not bankable, has made renewables more bankable. Similarly, we now are seeing the evolution of REITs and InvITs. And as the way that developers are thinking about this is you create a pool of renewable projects or a pool of roads, and then move it into an InvIT structure, raise capital against that, and then raise debt there. So what has happened now is that the developer has released his capital, which is in a sense the precious piece that we're talking about for the developer, which historically always used to get stuck in stuck projects, is now being able to be churned, through structures like REITs and InvITs. And banks are now, coming in there because they're now seeing that the project is more or less complete. Two is, to the point that that gentleman made, all the Canadian pension funds and everybody else is coming in and buying into these assets. That makes it, given the fact that they've done their due diligence, etc., the project becomes that much, or the InvIT structure or the project becomes that much more bankable. There is appetite in the banking system. I mean, maybe we are a bit of a minority. Maybe the larger part of the public sector entities are not doing infrastructure, etc. I don't think the banking system as a whole will be able to complete the national infrastructure pipeline projects. We need new money. We need new money through other pools of capital, including some of those ones that were mentioned, the Canadians and wealth funds, etc., etc.
Thanks, Rajiv. We'll take more questions, but before that, Rajiv, just can you briefly touch upon two aspects I want to ask you? Is this, yes, banks are into infrastructure in different format, you said that. But we get to know that in private conversation that bankers are not exactly excited about investing in bond, not only for the asset liability mismatches, but also for the M2M losses. It's like, if you can throw that, is that correct? Because, in the till the new accounting practices come in vogue, I mean, banks don't bother about the loan book. But in terms of there is no M2M losses there. But once you are in the bond market in a big way, you run the risk of, what happened in the last quarter, June quarter, because of the government bond. That's one part. Just briefly answer. And second is, Reserve Bank of India has been insisting that the corporation must do a bit of their fundraising through bond market. In 2016, it started, and it made it mandatory that every company that plans to raise at least 200 crore, they have to bond market through electronic instruments. So you can't just access bank loan only. Parallelly, you need to have access a part of the thing to the bond market. Are you seeing from the corporate client this is happening, or they are just silent on that? On that, briefly on the two aspects.
Yeah, so let me take the first one first. I think the issue of mark to market is a reality, and I think we've, as you rightly said, um, will always constrain banks. I mean, each bank will have different risk parameters to be able to manage their P&L on a quarter-on-quarter basis, and so therefore the amount of corporate bonds that they will actually hold in their portfolio will always be limited. But yes, banks like us, Neeraj runs that business. We also have a very active originate and distribute business. And so therefore we may not necessarily, we will facilitate the churning of the portfolios, being able to provide innovative bond solutions to our corporate clients on one side, and then, sell it down to insurance mutual funds, et cetera, et cetera. And so therefore, given the fact that mark to market will always be an issue, the amount of bonds that banks will hold will always be limited, because the only place where we're allowed to hold to maturity is the SLR portfolio. And so therefore, to that extent, this will always be a bit of an issue.
Second question is this: Reserve Bank of India has been insisting that every corporate
Yeah.
borrower must diversify. Along with the bank loan, they also need to raise money from the bond market. Is it happening, or they are giving it a go by?
So I think if you heard some of the statistics that the DG spoke about and the previous panel spoke about, the bond market is predominantly today a AA and better rated market. I mean, almost 80-85%, and within that, a large part of the issuances are by A, government entities, and two, NBFCs. So as you go into the rating profile, and if you look at particularly manufacturing entities as well, the amount of issuances is very small. And even if they do issue, I mean, it's on a private placement basis. Then it's a bilateral transaction between one entity and the other. But I think one of the things that I have been actually recommending to many of our corporate clients is to actually go out there and issue, particularly some of the larger groups, to go out there and issue bonds across their various companies, and in a sense create a group yield curve for themselves, so that there is a price discovery that will happen. Because if this is the reality that they need to work on, I mean, I may not necessarily know every company in the Murugappa group, for example. I'm just using a name here.
Sure.
But if they are able to issue various bonds across their various companies, then over a period of time, those become benchmarks, and then you can price them, because the investor community becomes a little more familiar. And therefore, to that extent, this could potentially evolve as well. Remember that corporates in general, except the very large corporates, in general, don't talk to corporate bond investors. They only talk to equity investors. So that culture of talking to corporate investors also has not yet taken off, and I think that needs to begin to evolve as well.
Thanks, Rajiv. Anand, I have a question for you. It's little unpalatable probably. We have been discussing only from the demand side, right? On the supply side, is it correct to interpret that many of the corporations are not actually interested in the corporate bond market? I mean, DG briefly touched upon on the lack of transparency in the pricing, but the sense we get is this: it's not only in pricing. I mean, there are a lot of other issues involved in it. Like, for instance, if I am a corporation, if I am in the bond market, for me, the day I defaulted, I mean, it becomes public, and it's embarrassment, and I have nowhere to, I have been stripped naked. But in the banking system, I can actually hedge my bet. I can play with, taking money from one bank and giving to another, and keep on defaulting, but not in the public domain. People don't know. I mean, it will take longer time to catch me. This is the reason I'm just saying purely from the demand side. Infrastructure is a different issue altogether. And to become a 5 trillion economy, of course, the focus is on infrastructure. And you did mention about how much money we need to raise. But apart from that, general corporate world, there is an aversion for the bond market, because I can rig the banking system, but not the bond market. I'll be exposed faster. Since you are pretty candid, is that correct assessment? on the
Okay,
demand
so
side.
I'm trying to be fair here.
You're all ears.
There are genuine issues that corporates mull over in terms of actually coming out with a corporate bond issue. I've seen very, very good corporates think 3 times about that as well.
What are the genuine
The
quote
issues are the
unquote genuine
following.
issues?
The issues
Yeah.
are the following. If you have to go through a listing process of corporate bonds in the exchange, it involves certain amount of bureaucracy. It involving rating agencies coming to and sharing information with them, getting a rating done. If you actually do a public issue, which by the way is what Deputy Governor Ravi Shankar was talking about, the amount of disclosures that you have to make and keep making to exchanges on an ongoing basis is very, very high, right? Now, if I am, for instance, a branch of an MNC company out here, right? Why on earth would I want to go through all of that when I can just go to my friendly neighborhood banker and get a reasonably sharp price done, given the fact that I have a good credit worthiness or whatever, right? So there are, how would I put it? There are justifiable reasons why you would think that for some players going through the process of listing, rating, etc., for a bond issuance might simply not be worth it. Okay. Having said that, as you rightly mentioned in your previous question, there is a regulatory nudge both from the RBI and from SEBI pushing folks into the bond market. I just hope that that pressure continues. It's coming in through 2 routes. One is there is a large exposure framework, which basically says that beyond a certain limit, banks cannot have an exposure to corporates unless you actually start to pay a very, very high penalty. Otherwise, you have to go to the corporate bond market and raise money from there. Likewise, SEBI has mandated, as you rightly said, that beyond a certain amount, if you're raising money, you have to tap 25% from corporate bond, etc. I think that's a good start, but unfortunately, pushing too hard on this side to get the supply through without having the demand ecosystem set out as yet, in terms of having adequate amount of buyers, adequate amount of liquidity, is also a problem. It's also a question of then becoming you putting the cart before the horse, right? Both have to go in tandem. As you nudge the supply side to come out and do bond issuances, I think it's important that we solve all the issues that we talked about on the demand side. I'll just say one more point to add to the issues, why I think this nudge towards bond markets is important. We talked about transparency in bond market, that can be improved, etc. The level of transparency in loan markets is much, much lower. Often you find that
That's what exactly
that's what
my
you're
question
alluding
was
to.
that.
That's what you're alluding to. So, I
Yes.
agree with you on that.
But you are acting, you are very diplomatically talking till now. Suddenly you are coming here.
No,
Till
as I
now,
said,
you are very.
just because a person is going through a loan route as opposed to a corporate bond route doesn't mean he's a crook.
Okay.
But crooks can prefer the loan route to hide a lot of issues and to get transparency away, which is one of the reasons why I think this nudge should happen. But it should happen in a way that the ecosystem can bear it. You can't just push the supply side without the demand side. I think Christian wants to add.
Essentially, I will eat my lunch this way, and you'll want to eat this way.
So
That's it. Fine.
So Tamalda,
very
you
Yeah.
talked about this
Suresh, yeah.
rating. Just
Yeah.
one aspect on, just to add to what.
No,
Anand-
two things
Yeah.
if you can throw us this thing
Sure.
in. One is this, he spoke about the role of the rating agencies, how 80% of the volume is actually AAA rated and all. And you're also in some part, quote unquote, villain rating agencies, not your rating agency. I'm talking about the raters per se, because in the 2018-19, what happened, all the AAA rated companies collapsed overnight and, So how do you see the role of the raters in developing the corporate bond market, which in turn take India to a 5 trillion economy?
See, for infrastructure bonds, the normal rating of PD is probably not the right way to look at it. I mean, the PD rating is 1 day, 1 rupee default, you will be in the dock.
Yes.
So, which is why the rating agencies have evolved this expected loss rating framework, which is about the loss through the life cycle of the bond. And the regulators are also pushing for it. The Ministry of Finance is also pushing for it. It's now for the market to actually take it up. Maybe lot bankers and the investment bankers also can actually educate the institutions, the investors to take this up more aggressively. I think this can solve some of the problem in terms of the PD rating format that we actually have.
Would you like to throw some light about, because in every discussion in bond market, we talk about the lack of junk bond market. So India should have one. This is the time right for that.
See, which is why I asked that question also to the previous panel on the differential in terms of how risk is priced. And you talked about that as well, in the sense, if I have a good relationship with a banker, and I'm going to get a loan at 8.5% or 9%, and I'm going to price it, I'm going to incur costs, and I'm going to go to the bond market and then get it at 10.5%, 11%, I would prefer the loan market. So that's a larger challenge. But in the context of infrastructure investments and the $5 trillion economy, clearly there is a role for the bond market to play, and there is a lot of appetite. Currently, the action is only centered around roads and renewables. We talk a lot about infrastructure investments, but it's only around roads and renewables. And there are
roads and
renewables.
Roads and renewables, yes.
So there are a lot of other aspects as well, which is where capacity building is also important. A lot of actions need to be taken by both the government, the regulator, and the participant stakeholders in the market.
Okay, we'll take questions, but before that, just Abhizar, one is this, what's your take on the taxation part of it? And anything else which is relevant we have not discussed?
No, I think taxation part, I agree, and everybody agrees that, if you want the retail investor to come in, you will have to have the SOPs that are required. Debt funds are preferred as compared to direct investments, and that's obvious. On the overseas side, I think the withholding tax issues are very, very significant because normally people add it onto yields. I mean, I know a very large, potentially AA candidate, which is borrowing at 18% rupee, simply because there is an add back of the whole withholding tax perspective. So I think on the withholding on taxation, generally interest taxation is more onerous than equity return taxation. I think that correction is required. I'll just hold on to one more point that Suresh, you just mentioned about, stressed assets and how they've been priced. I'll tell you of a live example. There is a corporate which had its debt restructured and settled with the banks.
Would you like to name them? No. Okay, fine.
It's okay. Settled with the banks by raising a lot of high cost money. And once their operation stabilized, it decided to go back to the same banks and say, can you now refinance this high cost debt? Literally.
Yes.
And the banks obviously said, we are no fools, so we will not do it. And he actually went to the bond market and he's just raised a BBB minus at 12.25%. He obviously went to the banks at 9.5%. So there is a 300 basis point gap, but he actually managed to raise money on a BBB minus bond. So there is a junk market which is coming up. As far as SRs are concerned, which are like bonds, not really bonds, they're payable enable bonds, but they're still bonds.
That security receipts.
Security receipts of ARCs.
Yes.
There is a SEBI regulation existing which talks about how you can trade in those bonds. And I think these kind of evolved markets have to happen. But the thing is that they will start with OTC markets because pricing them are very, very difficult. This particular bond also that happened at 12.25, I'm not sure whether it's really 12.25. But at least the markets will evolve as we move along.
Okay, thank. Yeah, please.
On the
And
point
then
of-
we'll take the questions. Yeah.
on the point on SRs, I'll just add the recommendations you made along with the committee on the ARC. Totally, I think, endorse that. That'll go a long way, I think, in increasing the liquidity of.
Yeah, this question. Yeah,
Hi, this
please.
is Manish Balwani from Value Creation Catalyst. I would just want to know the role of foreign money, which comes in and what is its impact on the Indian corporate bond market? Because it is for the first time that we are listing Indian economy at $5 trillion economy and RBI reserves going up. So my question would be, what would be your suggestions or any changes that you want as far as regulations for foreign bonds are concerned? And how do you see the picture? Or you say, let the foreign money come in, Indian corporate bond is here to grow.
Thanks.
So what's your...
Who wants to take the question? Yeah. Yes.
Maybe I can provide a contextual, quantitative
Quickly,
context.
then you can add or.
Yeah. So essentially, for this $5 trillion economy, you need the gross fixed capital formation to move from 30% to 35%. And given the national infrastructure pipeline, 70% of the investment is going to actually come from the government. The role of the corporate bond market is going to be limited. But even with a limited role for the corporate bond market, the amounts that we're talking about is really huge. Essentially, you need foreign portfolio investor participation to bridge the gap. The one measure that people are talking about is inclusion of the government security in global bond indices. I think it came through at some level last year, but again fizzled out. If it can happen over the next 12 months, I think that can significantly enhance foreign institutional investor participation in the local bond market.
Thanks, Shri. Anand,
I'll just quickly add,
one sentence, yeah.
it's maybe not a direct answer to your question. Here's a quiz question. I'm a professor. What is the total value of FPI equity investments in the country today? It's about, I'm going to give a guess. I don't have an exact number, but anybody? It's about $550 billion, give or take. Okay, $550 billion. What is the total amount of portfolio flows into debt so far in this country? It's about $30 billion. So the total amount of equity investments which we have allowed into this country over the period of time is about 18 times the amount of debt that we've allowed through portfolio flows. Now, if you're a country growing at 12% nominal and you can raise money at 6%, 7%, if you're a company doing that, would you raise equity or would you raise debt? You would obviously raise as much of debt as you could, right? As a country, though, we have always preferred equity markets and been very, very, surprised when we say, oh, we're raising debt. Okay. Of course, we compare with Argentina, etc., and we take it to another extreme. But the reality is today, 40% of our Nifty free float is owned by foreigners. We've sold ownership into our companies because we had aversion to debt. At least the next phase of our infrastructure growth, I think, has to be predominantly funded by debt as opposed to being funded by equity. Whatever be the mix, domestic versus foreign. Within foreign, let's not make the mistake of selling ownership into our growth.
Thanks, Anand. Yeah, this anybody? This
sorry.
gentleman. Sir, yeah, please.
Sorry if I'm asking a question which has already been answered, but Canadian pension funds and Australian pension funds, all of them are coming into infrastructure primarily as equity investors. So what needs to be done so that more of that is in the form of debt instead of necessarily expensive equity?
Who wants to answer this? Huh? You said it, no? Anand already said it, right?
It's a great point. By the way, to the other gentleman's point as well, I'm sure Rajiv and Jayesh, etc., have had this experience as well. We've had Canadian pension fund folks laughing at us, saying as a foreign pension fund, I've invested more in your infrastructure than your domestic pension funds have, right? Our own EP4, etc. So I think the starting point is getting our own capital markets right to the extent that we can raise domestic capital to the extent possible. By the way, we have a very, very vibrant saving ecosystem which can be used for raising this money. I think that it starts with that. Foreign capital is also welcome. Don't get me wrong. The fact is we are, as a growing country, we will always require savings from overseas. But I agree with your point about the shift between equity and debt completely. That's the point I was making earlier. There are various things we could do. Maybe over lunch, we could discuss what some of the things are.
Thanks, Anand. Yeah, this gentleman, there's the
Sure.
last question. Yeah.
Yeah, the question is with private capex of taking off, is it true that the borrowers tend to prefer bank loans rather than corporate loans because banks do give moratorium initially in the initial phase of capex?
I think it's that's not the only reason. In fact, the problem that as a corporate banker that I am facing is corporate India is throwing up so much money at this point in time. Debt equity is like at 0.6. The 0.6 is the new 1:1 debt equity, at this point in time. So typically what happens is, why do you need a moratorium? Because if you're putting up greenfield projects, by the time the project is completed and starts to churn revenues, etc., it takes some time, and therefore you have, you typically ask for moratoriums. As bankers, we would evaluate. One of the things that we always worry about is, why does the company need a moratorium? Is there leakage of money, etc., etc.? And so therefore we would, as long as we're convinced that the project needs the moratorium, we are, happy to provide that.
Thanks, Rajiv. So we are almost finished the time allotted to us. I just need one sentence each from you. The subject is role of debt market funding India's journey to 5 trillion economy. Starting with Suresh and ending with you. Just one sentence. We have not discussed. That's something new since. What exactly you want?
So
What do you need?
Yeah, confidence building measures in terms of transparency, in terms of resolution mechanisms. I think that's going to be really crucial, even in terms of governance of all the assets. Going to be crucial to attract not only foreign investments, but also domestic investments.
Okay. Anand?
No,
One sentence.
this is a journey. I'm sure 10 years later also we'll be discussing the same topic, but it's a continuous journey. I disagree with Deputy Governor Ravi Shankar that we should be happy with what we have. I think Dil Mange more. Lots of things which can be done going forward, which I'm sure we will work towards collectively.
Abhijay, sir. Transparency in credit markets and churn from banks. I'm just too sticky over the fact that banks should churn out.
Okay, Rajiv, now
Not sure why we should churn. but
onus
it's a
on
separate
you
issue.
to answer. Huh?
I have a don't. Do not provide a tax break for retail investors to get into corporate bond market. Offer that tax break to the other vehicles, insurance, mutual funds, and fixed deposits.
Okay, so that brings us to the end of, this is one subject we could have gone on and on, but we will not stand between you and lunch. So what are the key takeaways? There is no disagreement. Each and everybody in this house, on the stage, on the days, and in the audience, you agree that corporate bond market needs to play a very critical role. Debt market needs to play a very critical role in our journey towards 5 trillion economy. We know that we have been talking about it for decades. I spoke about 16 years. 2006, the first committee was done by former NSC chairman, R.H. Patil. And since then, we have been moving, but it's not enough. So there are multiple things we discussed need to be done. One at the take away all the micro regulations for the investors like EPFO and insurance firm, let them run their own treasury and decide what to do with their money and how to invest in the stock market. The banks need to be more proactive. That's what Abhizar continuously said. Taxation issue Anand raised, but Rajiv had a little different perspective that don't give the tax benefit to the retailers, give it to the insurance and other agencies and all. So, and there are many more issues, both on the supply side and on the demand sides. I think Bombay Chamber will need to have another discussion next year. And I'm not very sure. Of course, Mr. Ravi Shankar, if he comes, he'll be more optimistic probably. But the ground realities, is it changing very fast? Despite the best efforts of the government and the regulators, both SEBI and RBI, ground realities are not been changing at all. Not much. It's not a hare, it's a crocodile pace. That's what the corporate bond market India is moving. We hope that it gets the right kind of steam. That's very important to achieve the 5 trillion economy. So give them a big hand to all those participants. Thank you, sir. Thank you all.
May I now request our Director General, Mr. Sandeep Khosla, to present a memento to our moderator and panelists as a token of appreciation on behalf of BCCI. Thank you, DG sir. May I request you to please stay back on the stage. Thank you, Mr. Tamilda, Mr. Rajiv Anand, Mr. Abhizar Divanji, Mr. Suresh Krishnamurthy, and Professor Anant Narayan for such an effective and interactive discussion. We are grateful for your time today. May I request our Director General, Mr. Sandeep Khosla, to please deliver the vote of thanks.
Thank you, Priya. I'm indeed privileged to perform the pleasant task of proposing the vote of thanks today. On behalf of Bombay Chamber and on my own behalf, I extend sincere thanks to our keynote speaker, Shri Rabi Shankar, Deputy Governor, Reserve Bank of India, and our panelists, Mr. Neeraj Gambhir, Mr. Jayesh Mehta, Mr. Nilesh Shah, Mr. Rajiv Anand, Mr. Abhizar Divanji, Mr. Suresh Krishnamurthy, and Professor Anand Narayan. Thank you all once again for your insightful address to the members. Also to our moderators, Ms. Latha Venkatesh and Mr. Tamal Bandopadhyay, thank you for asking relevant questions. At Bombay Chamber, we believe in closely engaging and collaborating with our members. I would like to thank our knowledge partners, ENY, and event partners, CRISIL, SPA Capital Services Limited, and NRB Bearings Limited for supporting today's panel discussion. We do hope to continue working closely with all of you to ensure industry growth as well as making Mumbai an international hub for business as well as financial services. I would like to thank our board members, past presidents of Bombay Chamber, members of our BFSI committee, invitees and special guests for taking time from their busy schedule to be with us today. We have tried a hybrid model today and have been live streaming this on YouTube as well as via Zoom. Many participants have attended and there are some questions as well, which we will separately send to our panelists and give the answers back to the participants. All the activities and attainments of the Bombay Chamber cannot be accomplished without the strong and consistent support of the Chamber Secretariat, especially the admin and IT team. I would like to communicate my special thanks to Ms. Sugita Upadhyay, who has worked relentlessly to put this together at a short notice, and also to our colleague, Ms. Priya Singh, for comparing today's event. This, by the way, was her debut at comparing, and I must say she had done an excellent job. Thank you. Thank you once to all once again, and please join us for lunch. Thank you.